based in Hong Kong and other parts of Asia, so we got the tech space covered. Check it out. Mandeep Singh, Anurag Rana, senior analyst, we're kind of running that business for us, and we appreciate that. Markets, still a little bit of red on the screen. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning. A forecasted slowdown in Microsoft's Azure Cloud Services business. It's overshadowing optimism about its AI products. Now, shares of Microsoft right now down about 3%. Overall results in the quarter topped analyst projections, but Azure revenue growth, well, that slipped to 27%. That's down from 31% in the previous quarter, and it said gains would slow even further in the current quarter. Meanwhile, advertising and boosting Google's flagship search business, which is holding up against AI chatbots. Bloomberg's Gina Cervetti reports.
Parent Alphabet reported second quarter revenue that beat what Wall Street was expecting. The search business has also weathered an advertising slowdown that's affected social media companies more severely in recent quarters. Net income beat estimates last quarter too, and YouTube ad sales came in ahead of what analysts expected, which could be a good sign for competitors.
And shares of Alphabet right now, well, they're up about 6%. Snap shares, though, they're lower after its sales forecast missed estimates. Snap shares right now down about 2%. Now, that's a sign that improvements in the digital advertising business are taking longer than expected to pay off. The company behind the Snapchat social media app has been making a few changes, like adding tools that make it easier to match promotions to those people who want to see them. Now, Meta reports after the bell. And AT&T, they reported profit and free cash flow that topped analyst estimates. Revenue gained about 1%, and that's good news for the company. It faces a heavy debt load, also the potential high cost of cleaning lead out of its old copper phone network. But the company added fewer customers than analysts had expected. Shares of AT&T right now down, well, they're down about 1.5%. Those are the company stories.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, this Bloomberg Business Flash. Let's start off with the latest data. New home sales declining in the month of June. We got that at the top of the hour. This is the first time in 4 months, so it suggests the high borrowing costs and prices restraining momentum in the market. By the way, the median sales price of a new home declining to $415,400. Weighing on risk assets today, speculation the Fed Chair Jerome Powell is going to signal another interest rate increase this year isn't off the cards. A lot of analysts expect Powell to at least keep his options open at the press conference today. Investors also digesting mixed earnings from Microsoft and Alphabet. Here's one for you. Skittles.
Oh, yeah.
Introducing a limited edition Get ready for this, Madison.
Oh, no.
Mustard flavor.
No,
Skittles.
no.
They're
So-
just trying to get clicks. Like, come on. I see.
Well,
through
no,
that.
I've seen the packaging. It's a collaboration with French's classic yellow mustard. It's supposed to celebrate National Mustard Day, which is
A very
August
critical
5th.
holiday.
I didn't get you anything. And right now, the S&P 500 down 6. NASDAQ 154 points lower, and the Dow Jones Industrial Average down 4. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Madison.
All right, John Tucker, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Brokers studio. Markets, boy, what a turnaround this year from last year. Last year, you couldn't make a buck anywhere. Equities, fixed income, but this year, the equity markets are just ripping, particularly if you're in those big tech stocks. But what do we do from here? I mean, do we just go sit on the beach like John Tucker does every day? Or do you actually have to come in the office and work here? Karen Pai joins us, head of portfolio management and equities at Fiduciary Trust International. She joins us live here in our Bloomberg Interactive Broker studio. So, Karen, I mean, you're in the equities business. You've had a great first half of the year. Now what do you do?
Yeah, so I think investors really need to think about positioning at this point. I think the markets have been really pricing in sort of a slowdown in the economy, no recession or soft landing. So I think that there's a lot of good news that's currently being priced in and what's driven a lot of the stocks that have worked really well this year. I'm sure that you have talked about, the strong performance in the large cap tech stocks. I think that recently the market has started to broaden out and some of the cyclicals have started to participate, and that's a good sign for the markets. But looking at valuations, the markets are not cheap. S&P 500 is trading at close to 20 times earnings, and we're starting to see actually stocks not reacting so favorably when they do report decent earnings out of some of the tech companies, right? So it's interesting, and we're starting to see a better performance out of energy and financials. So I think that there is going to probably be some rotation and shift that's going to happen in the second half.
Well, it's interesting you bring up the market reaction to some of those tech earnings in particular that aren't actually that bad, but we're seeing a pretty negative market reaction. We're also seeing more negative revisions for some of those names. What do you make of those two factors?
Yeah, so earnings revisions typically lead stock performance. So in the first half of the year, we did see better revisions coming out of technology stocks after last year, where we saw mostly negative revisions and the heaviest revisions in those stocks. So, I think that now we're starting to see some of the reversals occur where we do expect that there would be a slowdown or a deceleration in some of the earnings growth expectations out of tech and communications. And we're starting to see improving revisions trends out of financials and energy and some of the more defensive areas of the market. So I do think that we should expect rotation to continue to occur, and I would stick with more of the defensive parts of the market going into the second half. I really like dividend yielding stocks and dividend growth at this point.
That's kind of where I wanted to go, because one of the areas maybe it could have hit out a little bit last year was with some of those high dividend paying stocks. I feel like this year maybe the market's looking to take on more risk, and so maybe that's not the play, but you're saying still be a little bit defensive?
Yes, I actually would be doubling down on the view to be
nice.
more defensive at this point. I think that, AI saved the day in terms of the markets, but, it's to be seen whether AI saves the economy, right? So I think that the economy is going to continue to slow down here in the second half, and the slowdown is still ahead of us. When I think about, the credit environment, consumer spending, CapEx spending, all of those things still point to a slowdown in the economy. So I'm not going to chase the rally in terms of what's worked so far this year. I'm going to position a little bit more defensively.
And what does that look like in terms of the allocation? Do you fill the boat with small caps, or do you kind of keep it even keeled for the rest of this year?
Yeah, so it's a great question, because certainly small cap has underperformed, and you think with the rotation, small cap is participating, but I don't consider small cap defensive. Small cap is cyclical, so yes, to your point about some of the rotation towards cyclicals, but I'm actually a little bit concerned about some of the ongoing deterioration in the financial sector and in the banks. So that leads me to still be cautious on financials despite some of the rally that we're seeing here. I would favor areas like consumer staples. I do think that we're going to see a rebound in energy, and I do think that actually healthcare would do well in the second half.
Yeah, I'm glad you mentioned energy because that's where I wanted to go, because I kind of felt like energy, which had been so out of favor for like a decade plus, had a nice couple of year run there during the pandemic. But I thought maybe it's kind of run its course. But now we've got WTI crude oil back up near $80 per barrel. So is there more room to go on some of these energy trades?
Sure. I think that my view around this is really about the earnings trends and earnings growth. So coming into this year, we expected relatively better earnings out of the energy sector. But I think what surprised is the level of production coming out of Russia that was, despite some of the sanctions that occurred. And you also had the concern about a slowdown in the economy that made investors wary of the demand side. As we go into the second half, some of the inventory levels probably will improve and you get better supply-demand balance. And again, here the economy is proving to be a little bit more resilient than it is coming into the year. So I do think that you'll get some improvement there. And these are companies that have really strong cash flow yield at this point.
Yep.
So that will be a favorable thing going for them.
And more broadly, you mentioned kind of the continued strength of the consumer. Are you concerned at all that we're going to have a recession or a high inflation environment that is still having this like strong consumer? I'm just curious about whether we're going to see an inflationary, recessionary combo thing that's just terrible for everyone. Can you make sense of that for me?
Sure. Yes, I think it's a very debatable topic because a lot of people coming into this year predicted that the consumer would slow down. And there was a concern about the housing market slowdown. And, things have proven to be a little bit more resilient. What's in favor for the consumer is the strong labor market. We do know that consumers have essentially spent down their savings. So there isn't that pent-up demand. But we also perhaps underestimated what people are calling YOLO, or you only live once,
they
right?
They keep spending.
And consumers keep spending.
Yeah.
But most consumers, outside of the top tier, are spending on credit. And we are seeing elevated levels of credit card usage. I think that there are signs for sure that the consumer is starting to get tapped out. And we do think that the consumer, what the market is now calling normalization, right? Consumer normalization, it's really just another way of saying the consumer is going to continue to slow down.
Okay.
What have we seen, or what have you seen or taken away from what we've seen in earnings so far this season?
So I think that we're continuing to actually see earnings growth slow and revisions. While we're starting to see a little bit more positives, they're not overtaking the negatives.
Okay.
So it's a stabilization in terms of negative revisions, but we don't expect a re-acceleration in earnings for 2023. I think the market is pretty optimistic that we're going to get 11% earnings growth for 24. But, I think that it's too early to say at this point, and we're looking at a flat to slightly negative earnings picture for 23.
Gotcha.
How does 11% earnings growth play into valuations, and does that make some of these Magnificent Seven names too expensive to the point where we start to see a little bit of a backing off of the big tech names?
Sure, yes. So certainly on 11% growth for next year, the market is still expensive at around 18 times. It's at the high end of the range. I think of it relative to what the alternatives are to equities. And there is an alternative to equities right now. You've got cash that's yielding over 5%, little risk for investors to no risk. So I think investors are paid to be patient here and to wait for the opportunities and for valuations to offer more of a cushion for that risk. So to your point about technology stocks, whether they're expensive, they are trading back at valuation levels that existed before the correction last year. So, the average tech stock in the large cap space is trading at around 25 times. It's not cheap at this point.
All right, Karen, thanks so much for joining us. Appreciate you coming into our studio here. Karen Pye, short walk across Midtown. Karen Pye, Head of Portfolio Management and Equities for Fiduciary Trust International. Always good getting folks here in the studio and getting their thoughts on these markets. Busy day for earnings, and of course, it is Fed Day. We will hear from Fed Chairman Jay Powell. He'll have his statement at 2 p.m. Wall Street time, then a press conference at 2:30 Wall Street time. We'll have coverage here on Bloomberg Radio and Television. Tom Keene, John Farrar, Lisa Abramowitz, the surveillance team, 1:30 p.m. Wall Street time. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Busy day for court proceedings as well, Paul. Actor Kevin Spacey has been acquitted of sexual assault charges in London. The 63-year-old actor had been on trial for 4 weeks over claims from 4 men who say they had unwanted encounters with the Oscar winner dating back to 2001. Prosecutors had called Spacey a sexual bully. Spacey's lawyer says 3 of the men who were liars, hoping to strike it rich, and Spacey testified in his own defense, saying his only mistake was making a clumsy pass at one man. President Biden's son Hunter is at the federal courthouse in Wilmington, Delaware. CNN is reporting he has told the judge he will plead guilty to 2 misdemeanor tax charges that will allow him to avoid trial on a gun charge. This was a plea deal that was first proposed last month. House Republicans tried to intervene in this case yesterday. They said the Justice Department may have put pressure on the lead prosecutor to go easy on Hunter Biden based on testimony from 2 IRS agents. British billionaire Joe Lewis has surrendered to insider trading charges in New York. The 86-year-old owner of England's Tottenham Hotspur Soccer Club is facing more than a dozen counts, including securities fraud. The Securities and Exchange Commission is also suing Lewis, accusing him of tipping his then-girlfriend and his private pilots with non-public information on companies in which he has significant stakes. Rudy Giuliani is admitting to making false statements about 2 women who counted the ballots in Georgia in the 2020 presidential race. The concession came in a filing last night in the federal defamation lawsuit from Ruby Freeman and Shay Moss. They accused Giuliani and others of promoting a video that claimed to show the 2 women manipulating ballots. In the filing, Giuliani acknowledged his statements against the women were defamatory, but could still be protected under the First Amendment. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major average is mostly lower right now ahead of the rate decision from the Federal Reserve. S&P 500, 9 points lower. That's down 0.2%. That should all change after 2 Eastern. At 45.58 on the index. Dow Jones Industrial Average, 20 points lower. And the NASDAQ 100 down 66 points. That's a decline of 0.4%. Seema Shah, Principal Asset Management, looking for a hawkish tone today from Fed Chair Jay Powell.
It pays them well to make sure that they maintain their hawkish stance. They cannot risk a further easing in financial conditions. So I think that's going to be his tone. But we have to remember Powell, when it comes to question time, has a tendency to let his true self out. So that's going to be what we're watching.
Stocks feeling some of the heat after disappointing earnings from Microsoft. Microsoft shares down about 4%. That's the biggest point drag right now in the NASDAQ 100. Microsoft posting lukewarm sales growth and a forecast of a slowdown in its cloud computing business. Now, on the other hand, you have Alphabet, the parent of Google, reporting revenue better than expected. And Walmart is dangling cash back on travel starting this week. Walmart Plus members, they can get 5% of their spending on hotels, car rentals, vacation activities in the form of Walmart Cash. They are trying to gain ground on Amazon Prime. They have a long way to go there. We check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker, and that's your Bloomberg Business Flash. Madison and Paul.
Yeah, he's not kidding. He checks the markets all day long.
He really does, even when he's stuck in traffic because of a crane issue.
He's got
You had to bring that up.
I did.
No, thank God. Well, minor injuries from
Yes.
that, but it's just like,
Thank God.
I think it's blocking our way home, is it not?
I don't know. I go underground. I just take whatever
Okay.
train pulls up
There
to
you
the
go.
I
station.
got to drive.
Anyway, all right, IN Go. It gets you the Bloomberg Index browser. And I look at the Bloomberg U.S. Ag total return value unhedged. It's up 2% this year, so the bond people are doing a little bit better than last year, which was a disaster. And I look at the Bloomberg U.S. corporate high yield total return. That's up 6.5%. So again, some nice returns in the fixed income business this year after a dismal 2022. How do you play it? Well, one of the ways is through, you can do some ETFs, kids. Joanna Gallegos joins us. She's a co-founder of Bond Blocks. That is an ETF biz that focuses on the fixed income business. Joanna joins us here in our Bloomberg Interactive Broker Studio. So, Joanna, where are you seeing kind of opportunities in fixed income this year after, again, a very tough 2022 for that sector?
Yeah, I think in context of 2022 and the returns year to date you just mentioned, like those are returns of broad indexes in fixed income, ag and obviously high yield and investment grade. And what we are I really want investors to do and encourage them to do, and I think what Bond Blocks is all about, is look across the full spectrum of fixed income opportunities across asset classes, and in particular, look a little further down the credit spectrum, all the way up into high yield. And that's because there's a lot of difference across the credit space in sectors and in ratings categories. And right now, with yields the way they have progressed, and they're going to continue to progress for the rest of 2023, and the resilience we've seen in these corporations' balance sheets, you know, you're being compensated very well for taking on this risk. You have a lot of income to cushion any potential downturns. And, you know, you should consider going even, you know, as far down, you know, the high, starting with triple B investment grade, down to triple C and high yield. You really need to take a look at those spaces, because I think there's a lot of strength there. And, you know, so far through all of this 2023, I don't think investors are paying too much attention there as they should.
And how are you thinking about longer duration and the calculation in terms of how much positioning to do around longer duration?
Yeah, so I think the important thing for longer durations, if you're taking very long duration, you're thinking that something is going to turn with the economy, and that, you know, you're positioning yourself for that event. The way we see duration is that it's a really important, precise tool that you should be managing, and you should be careful of how it is existing in your portfolio because it represents all the interest rate risk in your portfolio. So the way we think about it is across a whole spectrum of duration. So we would recommend that people along this path start adjusting their duration as we get more and more information. I mean, what people have been doing in our duration products to date is they've been, buying the short side of the curve and, reducing their duration as much as possible. I think they've really been doing that as a cash alternative, though, not really taking an investment view. And so, here we are. Our view is that it's unlikely that there's going to be a recession in 2023. But we have the tools that allow you to express that view.
So where are you seeing your clients, or where are you seeing the funds flows across your products right now? Where are people, because I mean, you could go to a piece of 2-year paper and get 4.9% just sitting in a 2-year treasury. Where are you seeing kind of some of the fund flows?
Yeah, so we're seeing a lot of flows in the shorter end because people are still positioning themselves with those risk-free yields. I mean, again, I'm encouraging our investors to look further out on either the duration spectrum or the credit spectrum. But we've also started to see a couple trades across the treasury curve into the belly of the curve, 5, 7, and a few long trades. So there's some notion. There's still, overall in ETFs, treasury ETFs, government ETFs are still, close, except for July, we're 60% of flows in ETF fixed income flows. So people aren't really stepping into that risk yet.
What's in your high yield ETF products? What's typically in that ETF?
Yeah, so what's different, again, back to comparing us to a broad-based index, whether it's investment grade or high yield or even the ag, is that we've cut up the exposures in high yield in particular into ratings categories and also sector categories.
Okay.
And what is really fascinating is you can really play some of these views that you guys talk about every day. If you want, the most balance sheet strength or with the lowest default risk right now, that would be the XBB product, right? So it's the first foray into high yield. That's the highest level of rating in high yield. If you really think that the recession isn't coming and we're going to avoid it in 2023.
Which is what I think.
Yeah.
I'm just waving my
You
hand.
should consider looking at the CCC product. It's yielding a lot. The default rate isn't above normal averages. And, if you even it's not about going all in, but it's about maybe adding some of that exposure into your portfolio just to improve your results. You've talked about it in the previous session, but consumer cyclicals in high yield
Yep.
is the best performing sector in high yield. So it's telling you, obviously, that's the strength of consumer. But in our energy sector product is also a way to play a really strong balance sheet and high quality because of what's developing, through the markets there. So the dispersion amongst the sectors and just the 7 sectors that we have is over 500 basis points. The best performing is close to 9%, which is consumer cyclicals. The worst performing is technology and telecom, and it's just about 3 or 4%.
Right.
So 500 basis point difference. There's a lot of opportunity that people should be considering as we still see this resilience and we're getting closer and closer to the end of 2023.
Yeah, this consumer resilience ticker is so interesting. I have it up on my terminal right now. It looks like you are having a great year in that space. What are kind of the specifics that go into that? Because I'm fascinated in kind of the continued strength of the consumer.
Yeah.
So I'm curious about the calculation.
Yeah, it's the same type of categorization you see in equity sector products. It's a group of issuers in that sector, consumer cyclicals.
Yep.
And so what it represents is all of the debt in our high yield products are representing those firms' ability to cover their interest, their balance sheets, their revenues, and how well they're paying their debt. And so, as the default rates are again maintained for historical averages this year, spreads are actually tightening across the category in high yield, not widening. So there's a lot to consider that, whatever category it is, if you're an energy producer, if you're an energy company, that's what's in our energy sector. So you're benefiting from the characteristics of those sectors, plus the characteristics of those individual issuers and the resilience and the health of the fundamentals that are there.
All right. We always love talking to Joanna Gallegos, co-founder of Bond Blocks. They do the ETF thing, but they do the ETF thing with that fixed income focus. So we don't talk about that maybe as much as we should. So it's great checking in with Joanna occasionally. So interesting there. Just looking at the yield curve right here. I mean, I'm looking at the 2-year Treasury. It's pretty much flat for the day, and it's sitting there at 4.88%. But I look at the 10-year off about 1 basis point, 3.87%. So still that pretty steep inversion on that whole yield curve thing. This is Bloomberg. All right, let's do some company news right now with Lisa Mateo.
Good morning. Deutsche Bank weathered their trading slowdown better than expected. Fixed income trading, it fell 10% in the second quarter, and that's ahead of most of the large Wall Street banks. Now, CFO James von Molk tells Bloomberg TV that there will be a bounce back in the second half.
We've gotten to a place now where I think the market sees the forward on interest rates, and we do see the potential for a pickup as we get into the sort of the downside of the cycle, if you like. As investors start to position for the timing and the extent of policy rate declines. I think that's early yet, but it's something that we do believe lies ahead.
As far as revenue for the rest of the year, Molk says Deutsche Bank is solidly in the upper end of the range it announced earlier this year of $28 to $29 billion. Now, shares of Deutsche Bank right now up about 0.5%. And another bank merger is on the way. Bloomberg's Steve Rappaport reports.
Lisa, PacWest will soon belong to a smaller rival in the latest rescue for a regional lender. Bank of California agreed to buy PacWest in a deal that includes a $400 million investment from Warburg Pincus and Centerbridge Partners. The banks say they'll sell assets to repay $13 billion of wholesale borrowings. The merger is aimed to shore up confidence after a run on deposits hit several regional banks earlier this year, leading to the collapse of 3 in California and 1 in New York. Lisa?
And checking in with shares of PacWest now, they're up about 27%. And shares of Wells Fargo, they're higher too, up about nearly 2%. And that's after announcing a new $30 billion stock buyback program that will consider changes to capital requirements. Now, that stock's already gained 13% this year. Those are the stories that are making the news.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Not much happening in the markets right here as we await the Fed this afternoon. The S&P off about 0.25%. The Dow Jones is completely unched on the day. The Nasdaq giving back a little bit there on some a little bit weaker than expected tech numbers out last night, although I think they were fine, and the stocks have been ripping anyway, so don't worry about that from my perspective. WTI crude oil, it's off 0.5%. Still, though, elevated relative to a month or so ago. It's $79.22 on the West Texas Intermediate stuff. Right now, let's head down to Washington, D.C. We'll get rolled in national news with Nathan Hager.
Okay, Paul. A jury in London has found Kevin Spacey not guilty of 9 sexual assault counts stemming from claims from 4 men dating back 20 years. The verdict for the Oscar-winning actor came after a 4-week trial and 3 days of deliberations. 3 men had accused Spacey of aggressively grabbing them. An aspiring actor claimed he woke up to find Spacey performing a sex act on him after he had passed out in the actor's apartment. The New York Times reports Spacey began to weep as the final not guilty verdict was read in that London court. President Biden's son Hunter is in a federal courtroom in Wilmington, Delaware, finalizing a plea deal on 2 misdemeanor tax charges that will allow him to avoid trial on a charge of possessing a gun while having a drug verdict against him. A Trump-appointed judge is going to need to sign off on this deal. It was announced last month, ending a long-running Justice Department investigation into Hunter Biden's foreign business dealings. But it might not end the impeachment talk against President Biden from House conservatives and Speaker Kevin McCarthy. Bloomberg Government's Jonathan Tamari has more.
McCarthy has had to really placate this group. And he's certainly giving strong hints that this is the direction they're going to go. And honestly, it seemed almost inevitable from the moment that Republicans took back the House that this is what would happen, almost as revenge for the 2 impeachments of former President Trump.
Bloomberg's Government's Jonathan Tamari there in Washington. He's just won a huge tentative labor deal for hundreds of thousands of UPS workers. Now, Teamsters President Sean O'Brien has taken aim at one of the biggest companies of all.
Amazon's definitely going to be a target to organize. We're going to take this historic agreement and use it as a template to show the Amazon workers what they will receive when they join the Teamsters Union.
Teamsters President Sean O'Brien told Bloomberg Surveillance he got the largest deal for UPS without having to strike. The union estimates it's going to mean $30 billion in higher pay and benefits over 5 years. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington, and this is Bloomberg. Paul and Madison.
All right, Nathan, thank you so much. We appreciate it. Madison Mills and Paul Sweeney here in the Bloomberg studios in Midtown Manhattan. I don't know, for this next story, John, I have to turn it over to Madison because you and I missed out on this whole swiping left and swiping right thing in our dating thing. It was just old-fashioned.
We did it the old-fashioned way.
Go to a bar and just hope for the best, I guess. I don't know. Try to be on your best behavior and hope
that would have
hope
been
for
a
the
joy.
best.
Just be our charming selves.
Exactly.
They just flock to you.
It just exactly. Talk to us about what's going on at Bumble.
All right, well, this is huge news in the dating app community, you guys. Bumble is the dating app where women typically message first. That's what differentiates this app. They launched a Bumble for Friends back in 2016, BFF for short, where people could just swipe to meet friends. Now they're making that a standalone app, specifically for platonic connections. Interestingly, the stock was up 4% on that news release. It's paring that a little bit down to still 2% gains on the
That's
day.
like a non-alcoholic beer.
Yeah,
what's the point?
It's for people who are, moving to new cities and they're on their phones all the time, so they're having trouble making friends, John. I feel like that would be your analysis of the situation.
Right.
So what percentage of your friends are app users for this whole thing?
I would say 100% of my single friends are on the apps, but the success rate of meeting someone on the app, that's where those numbers start to get a little dicey.
I got it. All right.
Your kids got to be on the apps.
I guess. I don't know what's going on.
That's a conversation for a
I wonder if it's a
post-dinner
coincidence.
drink.
Jess met and walked in just the time we were talking about this story.
I know. Jess, help me. I have no comments. We're talking about dating apps. I'm talking about dating apps with John
I'm out of this one.
and
She's
Paul
talking
Sweeney.
stock. She doesn't want to get involved in this story whatsoever. All right, we're going to have more coming up, including Jess Men. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, it is Fed Day, so we're going to break it down. We're going to do a little round table here with some of our Bloomberg Intelligence analysts. Ira Jersey, he's the chief U.S. interest rate strategist with the soccer suspenders he's sporting today. So we'll have him in. Anna Wong, chief U.S. economist with Bloomberg Economics. Boy, she's just been spot on every one of her economic calls over the past couple of years. It's just been crazy. So we'll get those two together to give us their thoughts here. Plus, Jay Hatfield, one of the smarter guests we have in this studio. He's the CEO of Infrastructure Capital Management. He's usually got some non-consensus calls, so we'll see what he thinks about the Fed, what he thinks about inflation. Always a good couple of minutes when we check in with him. Let's kick it off with John Tucker and get a Bloomberg Business Flash.
All right, Paul Madison, the S&P 500 dropping from the highest level since April of 2022. The tech-heavy NASDAQ 100 underperforming. The Dow right now is wavering. It's up 14 points right now. By the way, if the Dow does close higher today, that would be the longest winning run since back to 1987. Of course, the Federal Reserve anticipated to raise interest rates to the highest level in more than 2 decades later today. Over at Charles Schwab, here's what Kathy Jones is watching out for from today's Fed meeting and
what's
news
forward
conference.
guidance going to be. And I think the expectation is they'll sound hawkish, but they may indicate a pause. How does that get parsed out in the Q&A session? What does Paul kind of communicate here? Will we get a dissenting vote, possibly, or at least a hint that a handful of Fed officials are not on board with more rate hikes?
And data today, U.S. new home sales declining in June for the first time in 4 months. Traders also awaiting results from Facebook owner Meta Platforms. That comes after the close of regular trading today. The one in Manhattan here, it's been closed for renovation since 2017. I can't
Which
believe
one?
this.
Whoa.
But this hasn't stopped customers from ranking the Waldorf Astoria brand as the most loved luxury hotel brand.
Really?
That's the finding of a consumer satisfaction survey by J.D. Power that was out this morning. Marriott had, Marriott's brand, what is it, the Ritz-Carlton?
Yeah.
That had
Nice.
always been #1 for years, but
Or the Four Seasons. I mean,
displaced by
the Waldorf Astoria.
the brand. Well, I mean, it's not just one in Manhattan.
Yeah, but still.
Although that's a cranking bar when it's open.
Yes, when it's open. Exactly.
You don't need no Bumble for that.
We'll
There
be
we go.
hitting up that bar when that renovation's over, okay, guys? I want to see what it's like.
All right, John
in
Tucker,
action.
as we speak, downloading the Bumble app on the phone. We'll see how that goes. We'll see how that's going.
I
All right.
made a cut of a video yesterday of John Tucker dancing,
yeah.
and I feel like I'll send that to you. You can send it out, distribute
yeah,
it
Yes.
out
you can put it on the app.
Yes.
Honestly, God, I actually honestly forgot that this was like
Video.
on video.
It was great. You were just doing your
Yeah,
little.
that's going viral, John. You got to be
That's not
careful
gonna
what you
get
do
me
on
any
here.
dates.
That's not going to be on the Jersey Shore this weekend. Who knows what's going to happen? All right. John Tucker, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. And yes, for better or worse, we are streaming on YouTube. So just head over there and search Bloomberg Global News. Jess Metton joins us here, a voice of reason, as she looks at what's happening in this marketplace. Lots of earnings going on there. I don't know where you want to go, Jess. Take it away.
I don't know how to follow up with the Bumble chatter,
I
but
know
I'm gonna divert away after a decade of dating in New York, so I'm gonna get away from that one. But I'm looking at a couple different stocks this morning. I know we've talked so much about the tech growth stocks, but I actually wanted to point out more of a consumer-focused stock. I know that Maddie always likes to look at those as well, see the health of the consumer, but Coca-Cola,
Yep.
ticker symbol KO. So that stock a little bit muted this morning, but it did raise its outlook, and really that was driven by demand remaining strong there. And this does come on the heels. We did hear from PepsiCo in recent weeks that also reiterated that, and that's been a big thing because the concern has been, and we've talked about this for multiple quarters, how long can these companies continue to pass on these costs to consumers? And back in January, Maddie was actually working with our equities team on this, and we were all taking a look at how General Mills and then also Campbell's Soup had warned, hey, we don't think we can continue to do this. So we were wondering, would that be an early indicator for some of these other companies because their earnings were a bit off cycle? If you're looking from PepsiCo and Coca-Cola, you are still seeing some strength there, though I did wanted to point out how Coca-Cola's CEO, James Quincy, he did caution that some customers are switching to cheaper private label drinks that are, and then looking at when you're particular commodities. So if you're taking a look at sugar and corn syrup, those are still putting a bit of pressure on the company's margin. So I think that's why when you're looking at the stock, not quite up as much as you would think. It's only up about 2% this year. And then if you want to look at what's happening with PepsiCo, that's ticker symbol PEP, that's up more than 6% this year.
And look at this. Here's a function that Matt Miller likes. He's the COMP function, comparative returns. All right. So over the last 5 years, the S&P 500 is up 11.8% on an annualized basis over the last 5 years. Coke up 9.6, Pepsi up just about 14%. So Pepsi kind of a little bit outperforming Coke, but you know they're both kind of GDP kind of stories. It seems like kind of right in line with kind of the market, what's going on. But Pepsi's been a little bit better strategy. I know Ken Shea has said, who covers these companies for Bloomberg Intelligence, he says the market likes Pepsi a little bit more diversified with the snacks and the salty snacks and all that kind of stuff. Frito-Lays, and I'm a monster Frito fan.
There you go.
Oh, nice.
Yeah.
Good to know.
Maddie, do you like Pepsi or Coca-Cola?
I'm a Diet Coke ride or die.
There we
Till
go.
I die, I will drink Diet Coke. Yeah.
You know, I feel like I can do either one. Sometimes when I have pizza, I kind of want Pepsi for whatever reason, but I don't dislike Coke.
I feel like Southerners are more Pepsi.
Actually, Dr. Pepper is the
Texas.
thing in Texas. That is all Texas. So, but it's harder to get up here at times. So
Cherry Coke Zero.
There we go.
Coke Zero.
Can I just say I got distracted because Paul and I have been talking for weeks about these soccer suspenders, and he apparently wore them just for me, and I feel so honored that I got to see him in person.
Career highlight. I've never seen you in person, so hey, Ira Jersey.
This is the second
best
time,
day of my
so
life.
this is great. The other one I wanted to point out, though, we've all been talking about this. We know it's coming up after the Fed decision, but looking at Meta. So that stock is actually up more than 200% since early November. So back at the end of last year was when they had the big first tranche of job cuts. Then they had another one in the spring. So the big thing, even though we've talked so much about AI with tech and growth stocks, a lot of this actually had more to do with cost-cutting efforts as well as some of these job cuts that they did with some of these particular companies that were expanding so much. Apple, not as much. They didn't go through this gangbuster hiring like their counterparts did. But when you're looking at Meta, that was one of the companies that did. So they went through this. Obviously, it's very painful for people who lost their jobs. If you're looking at its stock, though, that's why it has been up so much. So when it comes to this, it's actually projected to turn to growth actually in the second quarter, and it's seen EPS rising around 19% after shrinking the last 6 quarters. So that's going to be really key after the bell looking at
it's amazing how the Meta story, which was like a lot of these tech names, just a top-line story, a subscriber story, just keep churning out top-line growth, and we'll worry about profits later. I think Amazon and Jeff Bezos kind of conditioned a segment of the market for that type of growth. But that changed last year. And it really, a lot of these companies led by, or most, I think most, explicitly exhibited by Meta, which really turned on the cost control measures. And boy, that worked for the stock.
And your buddies over at Bloomberg Intelligence are thinking that, especially because they just rolled out the threads, and they were taking a look at how that's outpacing ChatGPT. So they think that this new app could drive billions in revenue for Meta over the next few years.
All right, great stuff. Jess Menton, thank you so much. We appreciate that update. Good stuff. And now let's turn to technology, because we had the two big names last night. We'll do technology. Let's talk to the Fed, because it is Fed Day. Got ahead of myself there. Fed Day, 1:30 is Wall Street time. That's when we'll hear the Bloomberg surveillance team have their analysis starting. 2 p.m. we'll hear from Fed Chairman Jay Powell. And 2:30, or 2 o'clock's the statement. 2:30 will be the press conference. So busy afternoon on the Fed. Let's break it down with Anna Wong. She's from Chief U.S. Economist for Bloomberg, as well as Ira Jersey, Chief U.S. Interest Rate Strategist with Bloomberg Intelligence. So, Ira, let's start with you here. Again, it's so telegraphed here what's going to happen. You look at the warp function. It's been baked in for a while here. What would be a surprise to you, or what would be a surprise to the markets today?
Well, I think a surprise would be if they were overly hawkish at this point. Not saying, hey, we might hike again, right? Because that's in the dot plot, so that wouldn't be a huge shock. But if multiple rate hikes were kind of signaled, that would be, I think, a big surprise. I mean, what the market will key in on at 2 o'clock is there's a statement or a fraction of a sentence at the end of. I know this is the nuance that we get into, but at the end of the first paragraph, there's a little thing that says inflation remains too high. If they say something like inflation remains too high, but has begun to moderate or something like that, then the market would take that as being somewhat dovish, and you'd probably see 2-year yields go from just looking at my terminal right here about 4.88% maybe down to 4.8 or 4.75% almost in a heartbeat.
So he has to sound hawkish. That seems like the resounding consensus, at least Powell in his remarks. But Anna, what do you think is the likelihood of us getting a hint of accidental dovishness in Powell's commentary today, like we've seen in the past from him?
Yeah, so actually I differ from Ira in that I think the bigger surprise to the markets would be that he's overly dovish. There are a couple pieces of information that the Fed currently has more than the average person on Wall Street, which is number one, the SLOOS, the Loan Officer Survey, which is going to be released next week to the public consumption, but the Fed has it already now, and perhaps that we saw that the skip in the previous meeting was motivated by uncertainty over credit tightening conditions. And now they have in their hand the survey that tells them what will happen if the credit conditions are in fact tightening more than the typical person knows. And certainly we're seeing that in some of the high rejection rates of car loans, consumer loans lately. So it could cause Powell to be dovish, not accidentally, but deliberately. And the second thing is also the Fed has a lot more information about how to think about labor market and the underlying labor market job gains than the typical public. So I think if they see something that we don't, that could cause Powell to be more dovish.
Hey, Anna, I don't know if I've told you this yet, but I've officially taken the recession talk off the table. Of course, nobody cares what I think. They care what you think. What is your recession call here, given some of the recent data we've had?
It's still the same. So we still expect recession to unfold before the year end. And I am influenced by the soft landing calls in the sense that it did motivate me to look into FOMC transcripts on the eve of the December 2007 recession, and I discovered that at that time jobs gains were 166,000 per month, 2 months before recession began, and there was widespread positive economic surprise. There were a lot of talks of soft landing, and consumption was very strong even in October 2007, 2 months before recession began. So I think the comfort that people have derived recently from on soft landing is not very convincing to me. On the other hand, signs of credit tightening have been quite alarming for me.
Yeah, and Anna, you have a really cool function on the terminal that looks at language models of the Federal Reserve, and this chart, I can't possibly explain it to our listeners, but it's very, very cool. If you look up Anna on the terminal, you can take a look. Going back to you, Ira, what is your recession call at this point? Do you agree with Anna? Do you have a different take?
So, we use Anna's work, right? Anna and I work closely together. We don't always agree on a lot of the details, but I have no reason to dispute what she's saying. I think what the risk is that even if we have a slowdown, a significant slowdown that doesn't look like a recession, it would still put the Fed on hold, right? And that's a kind of situation where the front end of the yield curve, like so 2-year yields and other similar instruments would wind up seeing much lower yields and would rise in price. And that's one of the reasons why we continue to hold on to our yield curve uninversion call. I'm not going to call it steepen yet because with 2s10s at a negative 100 basis points, it's kind of hard to talk about steepening, but basically where 2-year yields go down and 10-year yields maybe do a whole lot of nothing because 10-year yields are already priced for a recession, whether it's this year, next year, 2025, doesn't matter. 10's already priced for that. It's really what that front end of the curve is going to do.
What is your year-end call for the 10-year? Where do you think we go here?
Yeah, I think a little bit lower than here, and that's based largely on Anna's call that we're going to have a mild recession. And
you're not using my call?
A 50 basis point.
That there's no recession?
It could, well, even your call. So look, I always bring this anecdote in. In 1994, we never had a recession, but we got a very significant mid-cycle slowdown.
Right.
I couldn't find a job after I got out of grad school, so to me, it was a recession.
Okay.
All right, but so it could feel something very much like that, where you have enough of a slowdown where there's pockets of the economy that feel like recession. You know, similar to say 2015 when we had the oil patch had a big problem, which a lot of us remember. The oil patch was in recession. It was a very significant slowdown in the economy, but it didn't last particularly long.
What are clients? What's the biggest pushback you get from clients on that? Like, what's an outlandish conversation with an institutional investor these days with you?
So I talk to a lot of people. There's definitely bifurcation. There's people who are in Anna and my camp where we think that we are going to have a recession or a meaningful slowdown. The Federal Reserve is going to not necessarily be more dovish, but certainly not be as hawkish as they have been, and they will not be hiking interest rates anymore. But there's a whole slew of people who are really worried about a secondary inflationary uptick, and that is taking on a very significant risk management role, I think, in a lot of people's portfolios, particularly in fixed income, where prices could be significantly affected way more than, say, equities would in another inflationary impulse.
Yeah, Anna, on that note, do you think that the cooling inflation we're seeing right now is potentially a head fake?
Well, I think that the cooling of inflation is real. It's not a fluke. However, I do think that Powell and FOMC needs to think about how they should design the policy. Given the data and shocks that we're seeing, I think 5.5% would be enough to bring inflation down. However, economic life is full of unexpected surprises. So suppose that UAW were to strike in a month and there's a severe adverse supply shock. On top of that, you have crazy El Nino weather that led to, that created a lot of destruction of food crops. Well, if at that time they decided to hike more, they will be behind the curve again. So whether they can foresee today potential shocks in the future and therefore buy more insurance by over tightening a little bit in order to buy that insurance, I don't think that that's in their current DNA. However, if I were a policymaker, I would over tighten a little bit in expectation of these adverse supply shocks, just to guarantee that the timetable of returning to 2% inflation will be met by 2025.
All right, smart discussion. Appreciate both of you coming on. Ira Jersey, Chief U.S. Interest Rate Strategist with Bloomberg Intelligence, and Amy Wong, Chief U.S. Economist with Bloomberg Economics, joining us here as we await the Federal Reserve this afternoon. And again, looking at the yield curve here, right there, the 10-year Treasury is off, well, it's kind of steady right here, 3.88%. The 2-year Treasury, 4.88%. That's a negative 100 basis points. I can do that math. And people like Ira and really smart people like Lisa Bromwitz tell me that inverted yield curve is important. I don't know. It's been inverted for a long time. I don't think they know what they're talking about.
I like the Paul recession tracker.
Yeah,
I
I'm
think
off.
That's the one I'm into.
It's off. We're not too worried about it. All right, we're going to have more coming up. This is Bloomberg. All right, let's get some company news right now with Lisa Mateo.
Good morning. The president of the Teamsters Union thanking its members for their support in reaching a tentative agreement to renew a 5-year labor contract with UPS. Sean O'Brien spoke with Bloomberg Surveillance.
We showed the entire country what you can do when you have the support of your rank and file members. I think we put some more energy into the labor movement, but also we got the largest deal done without having to strike the company.
Now, here's the thing. O'Brien said Amazon is the next target for organizing. Shares of UPS right now, well, they're down just a fraction. And Walmart is adding new travel perks to its membership plan as it gets more aggressive in competing with Amazon, Bloomberg's Gina Cervetti reports.
Starting this week, Walmart Plus members can earn 5% cash back for spending on hotels, car rentals, and vacation activities, and 2% back on flights bought through Walmart Plus.
Now, shares of Walmart right now, checking with them, they are up just about 1% right now. And some Chase Bank customers, well, they're trying to make payments through the Zelle network. They had some trouble making transactions yesterday. Not sure if you were one of them, but Chase issued a statement. They're saying that they're working to restore that full service. Now, Zelle did respond on Twitter, and it said that those issues, they were only on that Chase app. The rest of the network, they were running normally. Right now, we're checking in with JP Morgan Chase. It is up just a fraction now. We'll have more coming up on Bloomberg Markets with Paul Sweeney. And those are the company stories that we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, ahead of the expected 25 basis point boost in rates today from the Fed, the swaps market currently projecting a 52% chance of a move of the same magnitude before this year is over. Ahead of the Fed, the major stock averages, right now they've turned mixed. The two-year yield's also little change. They're at 4.88 right now. Traders also awaiting results from Facebook owner Meta Platforms. We're going to get that. They have to close a regular trading in New York today. The social media giant goes into the second quarter earnings report with relatively unexpected valuation. That could provide a cushion against any minor misses. S&P 500 right now, 10 points lower. That is down 0.2%. We're at 45.56 on the index. Dow Jones Industrial Average is up 10 points at 35,448. And the NASDAQ 100 is down 116 points. That's a decline of 0.6%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Maddie and Paul.
All right, John Tucker, thank you so much. We appreciate it. Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker Studio. We are streaming on YouTube. Just head over there and search for Bloomberg Global News, and you'll get the video feed here. Jay Hatfield joins us here in studio. He's the CEO, founder, and portfolio manager of Infrastructure Capital Partners, one of the smarter folks we have in here, which is a good thing on a Fed day. Jay, we make a big deal about the Fed here at Bloomberg. It's kind of our thing. How are you approaching today, and how do you think Fed Chairman Powell is thinking about his inflation fight and his economy?
Thanks, Paul. It's great to be back. Well, our view is that the Fed is really in the box. We think they have a flawed policy framework. So they're really required to raise rates at this meeting and maybe even next meeting because they're focused on the Phillips curve theory of inflation. So that means we really have to have a slowing economy.
When Phillips curve theory says simply what?
Inflation is mostly driven by employment and labor market.
Okay.
Whereas monetarist, which is how I was trained, although I try to be balanced, is that most of inflation comes from excessive monetary growth. We effectively had, a practice, MTM type expansion, money supply that led to inflation. Also had a price shock on the commodity side. But this Fed doesn't subscribe to that. They think the economy is slow. So the only way really they won't raise rates next time is if we do have a softening labor market, which we do think is quite possible. Not like a horrible one, but softening. So they might not raise next time, but they definitely have to, on their policy framework, raise today and maybe in 2 months or 4 months.
Yeah, but it's interesting to hear your criticism of how they're using their tools, because from where I sit, which is a way less educated seat than you're in, but they only have these two options, the balance sheet and raising rates. So what are they supposed to do if they want to fight inflation?
Well, thanks, Madison. Well, what they should do is either cut rates or pause, in our opinion. They really should cut when the banking crisis started. But so you're right. And in fact, I would really pair those two policy tools. A lot of people don't appreciate this, but you can't raise rates without shrinking the balance sheet.
Right.
It's helped by the fact they're now pay interest rates, but it used to be before interest on reserves, it used to be that they were one and the same. And so actually, that's a good clarification because people say, oh, well, shrinking the balance sheet's equal to 25. That's not really true. You have to shrink the balance sheet. In fact, the Fed shrunk the balance sheet to do the initial raises, and that's why they have all this reverse repo on the balance sheet. You have to do it net of reverse repo. Right. Anyway, that's a little bit obscure. But in any case, we think that they're kind of stuck in this policy framework because they also focus on PCE core, and that's a lagging indicator. It's distorted by medical costs. So we're going to get at least one rate hike and maybe two.
All right, Jay, I have to quote from your notes here. This is a good one. Quote, "We do not expect the Fed's hawkish commentary to significantly impact the stock market, as the market now understands that the Fed is incompetent and is terrible at forecasting inflation." Incompetent? What's going on?
Yeah, I think that if you sort of tried to take the opposite view and do a story on how competent they were, you wouldn't have any guess, or you'd be hard-pressed to find guests. They have to be former Fed officials or former government officials. So we think that today is going to be one of the lower volatility days for a Fed day. So regardless of whether the chair is a little bit hawkish or dovish, that the really dominant news is more going to be Meta and some of the other tech announcements, and that everybody sort of understands the Fed's bad at forecasting inflation. They've admitted as much. And so they're not going to be so concerned about what the Fed chair says, because even if there's another hike, I don't think people think that's going to be catastrophic for the economy.
Okay, before we move into more of a markets discussion, I have one more Fed question. Is there a possibility, in your view, that we could have an inflationary recession heading into the second half of this year or early 2024?
Well, the thing to watch, which a lot of people ignore, is that the economy doesn't just spontaneously combust. So everybody is always obsessing about the consumer and are they spending more or less. But what drives recessions, which are always caused by governments, is dramatic layoffs in normally construction and then manufacturing that goes into construction. But we have two offsetting factors.
Bidenomics.
Shortage, yes. I call it Mansionomics, but it's sort of what he allowed to pass, or Synonomics, because she didn't allow the corporate tax increases. But yeah, so you have tremendous government spending. We're estimating $200 billion, and then a resilient residential sector. So you're not going to have any layoffs. You don't have layoffs. 95% of spending, personal spending, comes from employment. So we continue, we've said this for about a year plus, that we're not going to have a recession, but you should watch those sectors. If the housing market implodes and or, private construction isn't offset by public construction, that's what you should watch. But you have to see one sector, not just the tech sector where people just move around, but where there's long-term unemployment, they spend less, and then that cascades into like the service economy that we work in, et cetera. So we're not worried about a recession, and we're not worried about inflation, but we know the Fed will continue to worry about inflation.
Jay, I have to admit, I don't understand how this labor market is as strong as it is, as resilient as it is. Do you have any thoughts?
Well, you did have so all this I would put into the category of post-pandemic tailwinds.
Okay.
Because it would be absolutely true, and I've been asked this hundreds of times, like, okay, the yield curve's inverted, well, we're going to have a recession. Well, that's absolutely true. Except we've never had a pandemic in modern financial history. In 1919 we did, I guess. So that's the exception. So you have tremendous demand up from the service sector, as we flip to services. Manufacturer's not impacted that much. And then this housing shortage, we never had a housing shortage like this. Right now we have about 1.5 million total homes, and that's an index you can look up on the terminal. So that's both existing and new homes, and that was 4.5 million during the financial crisis. So that is really the unique factor, is the pandemic.
Talk to me about how your economic outlook plays into, let's say we've got a chief marketing officer for Snap listening in, and they want to know how their ad spend is going to be impacted for the second half of this year heading into 2024. When can they anticipate getting a little bit more wiggle room in their budgets to be able to spend on the corporate side?
Well, we do think that the economy is softening, slowing, and that's why we don't think the Fed will raise rates, because we do think the labor market will come off a little bit. But in terms of more like a boom, I would say next year. So we get the Fed to pause, maybe even cut in the first quarter, second quarter, and then economic activity is likely to pick up. So ad spend may be a little bit sluggish, but it does help. The stock market's rising, so that helps consumption. We advertise more when the stock market's up, so I don't know if we're a good indicator, but so we'd say more than 24 to be bullish about companies like Snap, particularly.
All right, so you guys manage at Infrastructure Capital Advisors, manage a bunch of ETFs. Where are you seeing kind of the big flows these days?
We get most of our flows right now, appropriately, in our opinion, into our flagship fund, which is preferred stock.
Oh, okay.
Because that's a good, it's not conservative relative to fixed income, but conservative relative to financials. And so if you're kind of nervous about the market, but you still think we're going to recover, it has a beta of about 0.5. And the other thing about preferreds is you want to buy them below par. So they're all trading about 25% below par. And then, as I mentioned before, sell them at par. You can't forget that part of it, or at least reduce some of them at par. So it's normally a great cyclical trade. It was fantastic during the pandemic. It was fantastic after the financial crisis. And we think we're coming through this crisis, so we're recommending that. And if you're wrong and it stalls out, it still yields like 9+. So it's hard to make a huge mistake on that, whereas if you buy NVIDIA and they miss their earnings, then you're down 200 points and you don't get any yield from that. So that's where we're seeing a lot of the flows, and we think that's appropriate because you should trade preferred somewhat cyclically and add to them when they're down and lighten up when they're closer to par.
Final 30 seconds, an AI play. Do you have one that you like, or are you skeptical of all of them?
You know, we think that the ones that are in the blast zone, so that would be NVIDIA, is the best positioned. And just having, worked with CFOs, I just cannot believe that they haven't given a conservative guide. Like, if that's not the case, then they're not doing their job. So you don't guide at 52 unless you think it's 60 or 70, and you certainly don't guide to the next quarter. So that's what we suspect, but that's going to be a key inflection. And we do think that after NVIDIA, the market might pull back. I mean, we're super bullish about the market for the whole year, but play the cycles and worry about September, October, because those are normally horrible, and that comes right after the NVIDIA earnings.
All right, Jay. Once again, some really thoughtful discussion. Appreciate it as always. Jay Hatfield, CEO, founder, portfolio manager, Infrastructural Capital Advisors, joining us here in our Bloomberg studio. We appreciate that. Right now, let's head down to Washington, D.C. We'll get rolled in national news with Nathan Hager.
Paul, not guilty on all counts. That is the verdict from a London jury in the sexual assault trial of Kevin Spacey. The Oscar-winning actor says he is humbled at the decision.
I'm enormously grateful to the jury for having taken the time to examine all of the evidence and all of the facts carefully before they reach their decision.
Kevin Spacey had originally pleaded not guilty to a dozen charges. 3 of them were dismissed before trial. 4 men had accused the actor of aggressive, unwanted sexual encounters dating back 20 years. President Biden's son, Hunter, is wrapping up a plea deal to federal charges in Wilmington, Delaware. He is expected to admit to 2 misdemeanor tax counts and avoid trial on a gun charge. A Trump-appointed judge still has to sign off on the agreement. It will end a long-running Justice Department probe into Hunter Biden's foreign business dealings. Former President Donald Trump is signaling he'll revive his claims of a stolen election if he faces charges over his attempts to overturn the 2020 result. Former president posted on Truth Social this morning, quote, "We'll have fun on the stand with all these people that say the presidential election wasn't rigged and stolen," end quote. Last week, Trump said he had been notified he is a target of the Justice Department probe. That suggests federal charges are likely. The truth is out there. At least that's the hope of lawmakers on Capitol Hill holding a hearing right now on unidentified anomalous phenomena, better known as UFOs, says Tennessee Republican Tim Burchett.
Since 1969, the position of our military has been that UFOs pose no threat to national security and are not worthy of further study. I'd say that's the biggest understatement of the decade.
Congressman Burchett and others on the subcommittee heard from 3 former military officers who say they've seen UFOs. One claims the Pentagon is secretly holding on to extraterrestrial wreckage. The Pentagon denies having any destroyed alien spacecraft. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Dow Jones Industrial Average, let's give it some love. It is higher. It poised for the longest winning run since 1987. And dig a little deeper into it, one of the components there, Boeing, that's doing some of the heavy lifting for the Dow. It generated $2.58 billion in free cash flow in the second quarter. Meantime, Alicia Levine at the Bank of New York Mellon sees the recent market rally broadening out.
And what you saw in June was a switch. And all of a sudden you see it broadening out. And now you've got, a greater percentage of the S&P trading above the 50-day moving average. You've healed the market technically in many ways.
And weighing on risk sentiment is the idea that the Fed Chief Jerome Powell could signal another increase in rates this year at 25 basis points. That's pretty much penciled in for this afternoon. S&P 500 7 points lower. That's down 0.2%, 4560 on the index. The Dow Jones Industrial Average 25 points higher, 35,463 right now. Nasdaq 100, that's down 96 points. That's down about 0.6%. This is a story I never thought would be on the Bloomberg terminal. So they're having a hearing in Washington today. 3 former military officers telling Congress they saw unexplained flying objects, and one of them claimed the U.S. government secretly holding on to extraterrestrial wreckage.
Where'd you get that headline?
No,
JT?
it's on the Bloomberg terminal, which is why, it's just like, huh?
Curious. Exactly.
Okay.
Just wondering where you got it.
I'm waiting for them to find intelligent life in Washington as well.
Yep, all right. All right, John Tucker, thank you so much. We appreciate it. Looking at across the terminal, another headline. Hunter Biden plea deal with DOJ falls apart in court. That's that is on the Bloomberg terminal. NBC is saying that there's a 10-minute break to see if both sides can come to an agreement. But at the moment, no current plea deal between the DOJ and Biden. So we will have further reporting on that. We'll bring that to you when it happens. Right now, let's talk about this market. Again, just a really strong start to the year for equity investors. The question is, where do we go from here? We're right smack in the middle of earnings. We've got a Fed decision today, lots of pieces to move around the board. Justin Burgeon, he joins us, a VP of Equity Research at Ameriprise Financial Services. Justin, where do you guys at Ameriprise sit right now in terms of your market outlook?
Hey, Paul, thanks for having me. I appreciate it. So at the end of last quarter, we actually got a little less defensive than what we were heading into the year. So we still have kind of a barbell approach. We're overweight information technology as well as staples, and we're underweight some of those big ones that we've had this year, comm services and discretionary.
And how is the macro picture playing into your approach when it comes to positioning, particularly as we head into what's kind of a foregone conclusion for the day today with this Fed meeting, but when you look ahead to what the next call might be?
Yeah, absolutely. So I summed it up kind of in three bullets. I don't know why the acronym is LIE, but it is the truth. So you have labor, inflation, and earnings, right? So on the labor front, wages have actually been trending down. Set aside what the UPS and Teamsters came into, but average hourly earnings are coming down. They're still high from where you sit at an inflationary cycle, but they're receding. Second point on the inflation, CPI was 3% in June on an annualized basis, right? And here's the kicker, that our estimate for the end of the year is 3.5. So that may throw a little wrench in people's psychology, investor psychology, because are we going back into this inflationary cycle? No, not really, right? Because that's mostly a function of energy. Last piece of that is what you brought up, earnings. We're about 25% of the way through. It's a little too early to call the quarter yet. We're running a little behind from expectations, but net, there's not some massive fallout of downside pre-releases.
Justin, I see in your notes you're underweight consumer-driven sectors modestly. Why is that? It seems like the consumer's got a job, is hanging in there, spending some money. What's your thought there?
Yeah, so you're 100% correct. We actually went less underweight on the discretionary side at the end of last quarter. But look, that's been the right consumer spending, and the consumer in general is the story through this entire thing, right? The most forecast recession that never took place. Consumers continue to spend. You look at travel and leisure; it's extraordinary. But there's just a couple of companies inside of there that drive that sector. And flip side of the coin is we've been overweight technology, which has done very, very well. And even on Staples side, right? So that gives you a little bit of that barbell balance. If we do see a little bit of a rough patch in kind of the September-October timeframe, you could have some safety in the Staples side.
Interesting. So are you thinking in terms of safety, and you don't have to name names necessarily here, but I'm looking at a Mondelez earnings preview heading into tomorrow. We were talking about Coke, Pepsi. Are those some of the vibes of companies that you're looking to as a safety play in consumer staples?
Absolutely, right? Coke crushed it. So there was not a whole lot on the volume side, but 11 or 12% on the pricing side. That's driving earnings, right? So that has yet to work its way through on the Staples earnings side. So you're absolutely correct, yes.
All right, so how about U.S. versus non-U.S.? How do you kind of think about that?
Yeah, so one of the changes we made last quarter as well, we went less underweight on international markets. So, and I think, when you look at the setup, you have it's 30% discount to the U.S. Your dividend yield is almost 2x, right? So if you told an investor, hey, let's go in and buy S&P 30% below where it is today, they'd say on a multiple basis, absolutely, they're all in, and you get the dividend yield. There's some concerns on the growth side over there that haven't kind of worked through, but we have been less underweight international than what we have been. And there was a huge rise, right? So China and Hong Kong have been huge on the entire stimulus. That trade of not China not participating, that's done. But you have some of these stimulus measures coming through that could really prop up those markets as well.
And I know in your note you mentioned that you're expecting the narrow rally to continue to broaden out. Where do you anticipate seeing that broadening the most?
Yep. So if you look at equal weight S&P versus market cap, it's already there, right? 9 out of 11 sectors in Q3, since the start of Q3, already outperforming. And if you look small caps are 300 basis points over the S&P since the start or since June 1. So that's already taking place. I think if you look at that, so you mentioned broadening out on the breadth side. I think May, there was like 150 companies advanced versus decline. June was like 450, right? So that's already taken place. I think if you even back out some of those, the mega cap 7 or 8 that have driven the rally, your forward multiple is kind of right in line with what the market averages have been in that 16 change range. So there's not some massive overpricing. You can see that work its way into other parts of the economy.
All right, just real. That's we're going to leave it right there, Justin. We really appreciate getting your time. We've got some breaking news. Justin Burgeon, VP of Equity Research for Ameriprise Financial. But again, some news coming across the tape. Hunter Biden plea deal with the Department of Justice apparently is in jeopardy of falling apart, and he was appearing in court just this morning. So kind of an unsuspected kind of development here. Let's try to get a little bit of color here. Nick Ackerman joins us, former partner at Dorsey and Whitney, and he's got a lot of experience as a United States attorney. Nick, can you give some color of what may be happening down in Washington?
Well, I think the issue is whether or not this plea deal covers other possible violations or federal criminal violations that could have occurred during the time period that he's pleading guilty to the tax misdemeanors and the gun violation. So I think that's where it is. We don't really know where that's going to come out at the end of the day. I think we're all just waiting to see what the position of the government is and Hunter Biden's attorneys is. So I think it's a question of how that plea deal reads and what the parties intended. So we just don't know until we get further word from the court in Delaware and statements are made by both parties in this situation.
Nick, just generally speaking, in these types of cases, how unusual is it for this to happen, i.e., either some misunderstanding or a rejection of a deal that apparently had already been agreed to by the parties and the judge? How unusual is it to see it kind of break down at this stage?
Pretty unusual. This doesn't normally happen. There must be some reason why the judge raised this question. And there's obviously some misunderstanding between the parties, or this would have been readily resolved. And I think we're just going to have to wait and see where this comes out. But it is clearly not the usual course of what you would expect.
Right.
Agreed upon.
Right. And we're also joined here in our Bloomberg Interactive Broker studio with June Grosso, host of Bloomberg Law, and our go-to source for all things on the legal front here. June, a surprising development here in the Hunter Biden case. What do you think is perhaps going on?
Well, I don't know what's going on.
Right.
It is surprising, and it's also mysterious, because I'm sure Nick said that usually when you get into court to have the judge approve the plea deal, all these problems have been worked out, and in fact are usually in writing. Apparently in this case, the judge questioned whether or not that Biden was being given protection immunity from prosecution for other tax crimes or other crimes. And so you have to remember that the special prosecutor in Biden's case has said at different points that the investigation was ongoing. So perhaps there is some concern that, you know, there are other avenues that the special prosecutor may want to pursue against Hunter Biden, and his attorneys don't want him to sign it naturally unless he has immunity from prosecution for any of those past tax crimes. So it's very unusual, and usually these deals are all sewn up and they go into court and it's a done deal and the judge approves it. Also, you have to keep in mind that what's been happening in Congress with the Republicans in the House attacking this deal and wanting to call the special counsel into Congress to testify that he was not restricted in any way from investigating Hunter Biden.
So do you think there's any reason, is there perhaps political influence impacting this, what's happening this morning?
I don't know that there's political influence impacting it, but it's just that I think, there are a lot of questions surrounding the deal that might not have arisen if Hunter Biden wasn't Hunter Biden, Joe Biden's son. And also there are all these other avenues to try to attack Joe Biden. So I think that it has put a deal that would have been accepted as just rote under the microscope, and so questions are arising. But it's just surprising that this wasn't, hammered out beforehand.
Right. Well, that's one of the reasons that Chris Clark, Hunter Biden's lead lawyer, asked for a 10-minute recess and potentially attempt to come to a compromise, salvage the deal. June, from your expertise on the legal side of things, do you anticipate that short recess changing anything?
Well, it could work. I mean, it could be that they hammer out the deal very quickly, and that there was confusion about this, and they didn't nail down the details enough. Or it could be that they can't come to a decision. It's hard to tell. If it's just an oversight and things weren't nailed down properly, then they could come to a quick resolution of it. But otherwise,
it doesn't sound like an oversight, though, right? It sounds like a concern about.
It's hard to know because we're not in the courtroom and we don't know exactly what happened. We don't know about the plea negotiation, so it's really hard to make a judgment call on this when we just don't know the facts and who raised the concerns at the first place. Was it the defense? Was it the judge? It's sort of open.
So just again, the news across the tape is Hunter Biden plea deal with DOJ falls apart in court. It is in jeopardy, I guess is where we are, and there's a recess here as the parties sit down and discuss it. We're joined by June Grosso for Bloomberg Law and Nick Ackerman, former assistant special Watergate prosecutor. Nick, what role would the judge typically play in this type of, I guess, a disagreement is the best way we can phrase it now? Maybe
we might have lost him.
We lost Nick. Okay, no problem. So again, June, I'll put that to you. Kind of what role does the judge play here? Is it just kind of a mediator?
Well, in this particular situation, yeah, I suppose that he's going to try to, see if the deal can be hammered out. But, it's up to the judge. In the final call is up to the judge as to whether or not the plea deal will be accepted. So if they come to a decision, then he'll look at it and he'll decide whether or not to accept the plea deal. It's always up to the judge, but it's rare, if not, I don't know if it ever happens, where there's a plea deal that's been hammered out between the prosecution and the defense, and then the judge comes in and says, no, that's not good enough for me. I don't want that to happen. I mean, it's very, very rare. Usually the judges, approve these things.
Right. If this deal then gets thrown out, does that put potential prison time for Hunter Biden back on the table?
Well, I guess everything will be back on the table. I mean, there's a dispute. These are sometimes charges that, jail time is not normally associated with these kinds of charges, but, there's been all kinds of, criticism of the deal and looking at the deal in a different way than if he were just an average person on the street.
All right, so I guess, uncharted territory here just in terms of what's happening right now, but, I know I'm just kind of looking at all the various screens, the various networks are covering this. You just don't have a sense of, is this a short delay? Is this something they table for days, or we don't really know?
It's a short delay if they can come to if they can work out the details really fast. Otherwise, I think, it'll be put on hold, and then once they walk out of that courtroom, then, who knows what happens next.
All right, let's get some of the political angle here. Ryan Teague Beckwith, political reporter with Bloomberg News, is ready to join us. Ryan, what do you think is going on here?
It's possible that the whistleblower testimony from the IRS undercut this plea deal because, that was just additional information that his lawyers had, and they may have looked at that information and said, actually, I like our chances now. So that's, it's like when you're buying a house and they tell you, like, don't open any new credit cards, don't, don't change anything about the underlying circumstances. So once more information came out, that it's entirely possible that just it changed their decision.
Well, it seems to me that the judge was skeptical about the deal from the beginning, particularly when we look through some of the reporting we're getting from those who were able to get insight into what was going on in the courtroom. Do you anticipate this short recess they're in right now changing the judge's view on this deal that the judge was already questioning previously?
If prosecutors and a defendant want to make a deal, they're usually going to be able to do that. It's not in any judge's interest to force people to go through with a trial that neither side wants. I think certainly the skepticism may be adding to it, to the sort of back and forth. And sometimes, these kind of last minute negotiations, it's like a business deal. You get everybody to the table, and then somebody says, I got cold feet, and they don't really, they just are seeing if they can maybe tweak the deal a little bit. I think it's really ultimately Hunter Biden wants this over. Yeah. He's trying to put this behind him, and there's really he's not facing such horrific potential outcomes here as a first-time defendant on this kind of thing. That it's not something he can live with. So I think he's just trying to maybe see if he can get a little sweeter deal.
Ryan, just about 20 seconds left. Any reason to believe that political influences are at play here?
The whole thing is, it's impossible to separate from the political influences. I don't think it's a case that would have been brought if he weren't such a high-profile person. I also don't think he would be. I think there's a little bit of pressure for him to resolve this quickly and get it past him, in part to avoid creating more political problems for his father.
All right, Ryan Teague Beckwith, thank you so much for joining us. June Grasso as well, thank you for your insight here. Ryan Teague Beckwith, Bloomberg News down in D.C., and June Grasso, Bloomberg Law program here, host at Bloomberg News. Right now, let's go to Denise Pellegrini. We'll get a business flash, reset this whole thing.
All right, yeah, we're watching the markets for you all day long here at Bloomberg. Just about almost the top of the hour. The Fed, of course, we're expecting that announcement in just a couple of hours on an interest rate hike. And we do have breaking news on the Bloomberg Terminal Airbus. It is reporting second quarter adjusted EBITDA that's a little bit stronger than estimates. Remember, we had stronger than expected results from Boeing earlier. Stocks are mixed, though, ahead of the Fed's expected announcement on rate hikes. We'll be tracking it all for you. Special live coverage here on Bloomberg Radio of what happens and what it all means. And Max Kettner, Chief Multi-Asset Strategist at HSBC, he says, well, it's important to remember the next couple of months look pretty good, but not clear what happens after.
CapEx intentions, regional Fed surveys, things like new orders over inventories, they've all been picking up in the US specifically. And all that would tell us perhaps that those two things over the next couple of weeks and months are pretty good. Thereafter, that's the question mark.
Yeah, and that's the question mark we're all watching for. Kettner there on the Bloomberg Surveillance podcast. And of course, speaking of U.S. economic growth prospects, we will be getting U.S. GDP numbers tomorrow. Right now, though, the Dow is up about 44 points. That's about 0.3%. The S&P 500 and the NASDAQ, though, they are both negative. S&P down just about 0.1%. Call it 6 points. And the NASDAQ down 0.3%, now 43 points. Checking the 10-year, yield on the 10-year coming off a little bit yesterday's levels, 3.87% right now. And spot gold right now, it's higher again today, up about 0.4%, 1972 an ounce. And crude oil, let's see, crude oil here, if we can find it here, crude oil, it is trading lower today. We did have a couple of days higher yesterday and the day before. You remember crude oil now down about 0.8%, 79.90 a barrel. And also we're watching shares of Facebook parent Meta. Big focus when they report after the bell on whether the expected recovery in the digital ad business actually took place. Also, we'll be watching for anything at all they say about Threads. And that is a Bloomberg Business Flash. Back over to you guys.
All right, Denise Pellegrini, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube, so you can just head over there and search Bloomberg Global News, and you get a sense of what's happening there. Coming up in this hour, we're going to check in with Alex Chaloff, co-head of investment strategies at Bernstein Private Wealth Management, to get his market call. Then Jeffrey Cleveland, director and chief economist at Payton & Regal, talk about the Fed and his call for a soft landing in the U.S. And then we'll check in with Allison Williams, senior bank analyst with Bloomberg Intelligence, discuss Deutsche Bank earnings, Wells Fargo buying back stock and dividend announcement. Lots of stuff happening with the big banks, and Allison Williams is our go-to person right here. Let's start off by just kind of looking at these markets, look under the hood. We just heard from Denise. We've kind of got a mixed market out there with the S&P pretty much unchanged on the day. Let's check in with Alex Semenoff. She covers all the markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at?
Well, guys, I love a good story about the underdog. This year has been all about the S&P 500, about the NASDAQ, but the Dow Jones Industrial Average is finally getting some love. It is teetering on the brink of a historic winning streak, and what Fed Chair Powell says during that press conference today will determine whether it can lock it in as it fluctuates between small gains and losses. If it does indeed close in the green, it would mark the 13th straight positive day for the blue chip index. That's a span of consecutive gains we have not seen, guys, since January 1987. And despite what happens today, the Dow's recent rally is really a sign of investors getting more confident in the economy and kind of moving away beyond the safety of mega cap technology stocks. I have to point out a great story on the Bloomberg terminal right now by my colleague Esha Day, who covers industrials for us. You could read more about the Dow there. And the biggest boost to the index is coming from Boeing today. It reported cash generation in the second quarter that far exceeded expectations, which is helping lift shares today, and also offsetting some of the losses that we're seeing in Microsoft after it reported a tepid outlook for its cloud business.
And Alex, you have a taking stock column about some of the moves that we're seeing in the Dow, signaling more gains heading into the second half of the year. Can you talk to me a little bit more about that theory and what that's going to look like when it comes to the trade?
Indeed. So as there's this big cloud this week over the rally in equities with earnings and the Fed decision, some technical indicators actually suggest that stocks could continue to run well into 2024. There was a great note out yesterday from Bank of America Chief market technician Steve Sutmeyer. He points to a few different indicators that he's watching. The first is the Dow theory, which is a technical strategy that points to a continued uptrend in the stock market if both industrial and transportation stocks advance above previous key highs. There are also some bullish signals when you look at brokerage activity, a closely watched measure of growth in margin debt, or that's the total funds investors have borrowed from brokers to buy stock. It moved above a key level that has historically been associated with positive forward returns for the S&P 500 for 1 month to 2 years. So he really sees a good run well into 2024, even as some worry that this rally might not have staying power.
Our good friends at the Gap. I guess there was a management change there today, Alex. What's
yeah,
happening
so
with the Gap?
Definitely a big story with Gap today after news broke that Mattel Chief Operating Officer Richard Dickson, he is stepping into the role of Chief Executive Officer at Gap. Both companies released announcement today. Shares of Gap are moving higher and shares of Mattel were moving lower last time I checked. This ends a year-long search for Gap. It was really taking its time looking for the perfect CEO as it sees improvements in inventories, in cost savings, and redesigning its brand. And this could really continue its upward trajectory. Bloomberg intelligence analysts say that its turnaround prospects are looking much brighter after this announcement. And of course, Dickson already sits on Gap's board. He's had experience at places like Bloomingdale's, 9 West, so really reassuring sign for Gap and met positively by analysts.
Yeah, and I'm going to be covering Mattel earnings later today, so I'm excited that I have a lot of fodder for that conversation, Alex. Totally switching gears here. I want to end with you on the PacWest situation today. What can you tell us about that?
Yeah, so PacWest shares jumped as much as 30% following news that it is being bought by smaller rival Bank of California. The merger is aimed to kind of restore confidence in banks after a run in deposits earlier this year. The combined bank will have about $36 billion in assets. That's less than PacWest had alone at the end of March. And analysts seem to like the structure of this deal. Some positive reactions from analyst notes today. Truist Securities analyst Brandon King says that M&A was the most practical course of action here. Wells Fargo saying this is one of the first deals that has appeared to be a thawing of the regulatory pressures on bank deals. And then, of course, Piper Sandler says that it likes to structure the deal with low execution risk, and this gives the opportunity to create a more valuable franchise amid dislocation in California. So positive reactions there from Wall Street so far.
All right, Alexander Semenova, thank you very much. We appreciate getting that market update there. Lots of news out there. We got a Fed day today, so lots to talk about. So we appreciate getting some of your time. Let's go right to our next guest, Alex Chaloff. Is it Chaloff or Chaloff?
Shaloff.
Shaloff. Okay, I'm on that.
Put your shawl on, you take your shawl off.
Hey,
there we go. Boom. I like that.
He's a smart guy because where did he get his MBA?
USC.
Best university in the world.
There we go.
Hello.
Fight on.
Fight on, man.
I like it. Alex Chaloff.
We've got a Duke guy in the room. So
CIO of Bernstein Private Wealth. That's a good name on this street, Bernstein. Alex, we got a Fed day today. We make a big deal of it here at Bloomberg. What are you looking for here? What are you telling your clients here as it relates to our Federal Reserve and its impact on the market?
No surprises this afternoon. They raised 25. Chair Powell is extremely hawkish in his comments. Market doesn't like it, but that's reality. And then we move on. It's all about September 20.
And as you know, Jay Powell has to be hawkish, and he's going to be, but sometimes you get a tiny slip up in his comments, and he reveals a little dovishness. Are you anticipating that?
I think the last few meetings we haven't seen the slip up, or intentional or otherwise. Our view is that he is very deliberate in his language. It's like a free lunch. There's no cost to him being hawkish. It doesn't grow the balance sheet. It doesn't change the economy. He can do it. And if all the harm is that he moves risk assets down, that's okay. So I think he'll be very disciplined, very intentional in his language.
Well, Alex, I mean, the risk I see out there is he's going to push this economy into a recession. Who wants that? I've taken recession off the table personally, but he could push it right into a recession. Who wants that?
He could, but our house view is that a soft landing is highly likely.
Okay.
It's largely on the back, or almost entirely on the back today, of the strength in the labor market, which will flow through to the consumer. You have an unemployment rate, which for all intents and purposes is effectively zero. Anyone that wants a job can find a job. You've got 25 to 54-year-olds, 81% employed. That's a 30-year high. You've got wage growth finally tipping back to positive. So our view is that the strength in labor is strong enough to push us through. And look, if this is it, if this is a hike, some hawkish dialogue, and then a pause, or we get the same thing in September, we're through. So we are very close to the end of this. So we're optimistic about it.
What's your timeline on a soft landing?
It's going to be over. They'll tell you when it's over.
Okay.
Right? It's going to be one of these things where in a year they'll say, oh, guess what? We were 0.1 or maybe even had 1 quarter of negative GDP, but that's it. But it'll be a 2000 and end of 24 event where they talk about 23 and Q1 24.
Do you think there's a potential then of us getting to that soft landing, but the consumer still feeling like inflation is just as bad as it has been?
I think that's a reality. The good news is that household balance sheets continue to be strong, and you get some wage growth that continues to grow on itself. I think the compounding effect will make things easier. You've already seen some pullback in some of the blowout areas of inflation. Used cars has come down. Airline prices have come down. So they've been isolated, but they're starting to happen. So our view is that inflation isn't going away. It's not going to zero overnight. And it's not as if we'll be in a deflationary period. So you're not going to go fly Los Angeles to New York for $199 anymore. That's just the reality. But as far as year over year changes, those will be certainly less extreme.
All right, so given that kind of backdrop, what are you telling your Bernstein Private Wealth Management clients to do here? How much risk are you putting on the table for them?
There's two main themes that we're focused on. One is extend duration. Don't be afraid of the bond market.
Extend duration.
You got it.
Duration. Okay. All
it's cash. You've been nice.
I'm getting 4.88% my 2-year.
We cash and short term. We had a thing.
Okay.
It was okay.
Okay.
But now we got to move on. It's not you. It's me.
Right.
So we're breaking up with cash and money markets and looking at extending duration. I think you're going to clip the coupon while you wait for the Fed to be done. If we get an equity market sell-off, and everyone who thinks soft landing is wrong, guess what? Bonds are way more protective than something in money markets in short. And next year, our view, when they start cutting, you'll pick up price appreciation. So we might be early, but I'm okay. I'd rather be early than late here, and I think we're just on time, by the way. That's theme one. Theme two is private markets. Take advantage of the dislocation that's occurred in the private markets and start to put money to work. That's probably a 3-year theme, but it's happening right now. Some really interesting opportunities in privates.
So how do you do that? How do you play the private markets?
I think you're patient, especially in real estate. I think you want to say, this is interesting, but this is probably a Q1 24 start date. So continue to watch, maybe for a selective deal here or there. It's interesting, but on a wholesale fashion, I'd wait till next year. Private debt, very interesting today. There's a lot of different ways that you can access that market with fresh capital, both for original originations, new originations, as well as secondary purchases. That's a big, juicy part of the market. And then I think in private equity, it's just start to dip your toe and engage in other people's mistakes over the next 2 and 3 years. So whether you do that through primaries, they're taking advantage of a reset in the valuation market, whether you do that through secondaries that are buying other people's mistakes and taking advantage of some real motivation to sell, I think there's a number of different ways you can play it.
Are you still seeing a lot of dry powder out there?
Huge, huge. I mean, the only thing that I would say is you're starting to see institutional LPs that took off 2023 because their portfolios were upside down with liquid versus illiquid. They've signaled to the market we're probably going to take 24 off as well. So big institutions walking away from the market. You still have sovereign wealth guys. They're not stopping at all, and in fact not turning that dial up. But then the ultra high net worth, the Bernstein client is looking at allocating to private markets in a greater degree, than they have in the past. So I think you'll have that balance. It'll be a mixed shift of who's the owner. But yes, lots of dry powder.
How about the hedge fund allocation? What are you guys suggesting for your clients in terms of hedge funds?
It really depends on what you're trying to accomplish. I think hedge funds as a blanket category, people have had to revisit, and for good reason. Returns there were disappointing in 2015-16, 2018-19. Some of them weren't protective during COVID. But for someone that has a big equity exposure where they don't want to give that up, but they want something to neutralize it, that's where hedge funds play a role.
And I have to ask my favorite question here at Bloomberg, the AI play. Are you getting any questions about it? Are you hearing a lot more skepticism because of the wealth level of your clients?
I think our clients so the answer is yes. People are asking about AI. Bernstein has done tremendous research on the topic and have published on it in a number of different venues. But the questions our clients are asking more about the productivity, the change in the labor market. Will this destroy jobs in the next 10 years? Will my grandchild graduating college in 2025, are they going to have a job? That's where people are focused on. And our view is these things take a long time to play out. We'll likely have some productivity gains that will be additive to the overall economy, but there's some things that just can't be replaced. So I tell them what I tell my own kids, my teenagers, find something to do that a robot can't do.
Right.
And if you focus on that, you're going to be okay.
I think it'll be okay. What are some of the things you're suggesting your clients stay away from at this point?
I think, commodities are tricky. You've just got to be careful there. I don't know if that's a stay away from. I think that's an area. I think the shorter term, as I said, we're breaking up with short term fixed income. So I don't think there's some bomb that's going to go off in the Treasury market in the 0 to 2s, but that you're going to give up. You're going to wake up in 3 years and regret having owned anything in short duration through this cycle. Other than that, this has been a wild market. It's like the rally that's like a non-rally,
right?
And so it doesn't feel maybe to everyone that it is a rally, but we called the bottom in October. We wrote a note to our clients in October of last year to say the next bull market has begun, and it has.
Do you think the market's a little too far over its skis here? With again, the market's moved up 30-some-odd% off of that low.
I think you're spot on, especially with what's going to happen with earnings. You had a negative earnings in fourth quarter, a negative earnings in first quarter. Our expectation, I think we're right on the market of a negative 8% earnings. So this is the real, nuclear winter in the earnings cycle for the S&P. And if you look at where the S&P levels are, we were before this morning 5% away from an all-time high. That there's a disconnect there. So
yeah.
we're people talk about the Magnificent Seven.
Yep.
We talk about the forgotten 493. And that's
Right.
where the interesting opportunity could be in the next chapter.
Where are you seeing the most opportunity within the smaller caps that's being ignored right now?
Small caps are really interesting. I mean, the growth part of that market has exploded, having a terrific year. The more value, which is really banks, small cap value on a look-through basis are basically financials, and we know what's happened there over the spring and the stress around bank failures. So I think small cap as an overall allocation still makes sense. It should be a smaller part of the portfolio. But I'd rather play that as an asset class than try to find a name or two.
Yeah.
You can be active, and we are in the small cap space, but I don't think you want to be concentrated in any way, shape, or form.
Just 30 seconds left. Energy, kind of people, I don't think can really agree on what to do with the energy trade. Are you guys still long energy? Because it's had a good run over the last several years.
We've been selective in energy and frankly had the right name, so feel really good about our exposure. But, long term, a lot of questions around the energy platform and the infrastructure, the cost of debt. It's heavily levered as a space, so just be cautious.
All right. Alex Shaloff, thanks so much for joining us. Alex Shaloff, he's the CIO of Bernstein Wealth, or Private Wealth. I want to get that correct. Alex Shaloff joins us here in our Bloomberg Interactive Broker Studio, looking at the markets here. Again, kind of a mixed kind of look out there as we await the Fed in just under 2 hours with a statement. We will have obviously the press conference at 12:30, and Bloomberg surveillance team, Tom, John, and Lisa will have their broadcast, simulcast radio, TV broadcast at 1:30 p.m. Wall Street time, getting us all set for that Fed, and that's coming up 1:30 Wall Street time. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. After reaching a tentative deal to boost pay and benefits for UPS workers, the president of the Teamsters Union, Sean O'Brien, he tells Bloomberg TV that he has his eyes on a new target. It's Amazon. Now, the union plans to use that momentum from its win with UPS, which he says shines a light on organized workers.
I think we added credibility to the process, and also, more importantly, we set the tone for what organized labor can achieve against corporate America and these high profits, and we want to be rewarded. Our members need to be rewarded.
The Teamsters estimate that deal will add $30 billion of new money for workers over a 5-year span. Shares of UPS right now down just a fraction. Meanwhile, SAG-AFTRA union members, well, they're still walking the picket lines, and this as Netflix is looking to boost its use of AI. Bloomberg's Ed Baxter has that story.
Union members have begun showing up outside the Los Gatos Netflix offices as one of the demands is a larger share of streaming costs, but also on the discovery of Netflix posting a job that will look to enhance its footprint in AI. The job is for a product manager to help steer AI ambitions. The role's proposed salary goes up to $900,000. The performers fear being replaced by AI, so this may become a new front in the labor war.
Now, Netflix shares, checking with those, are down nearly 2% right now. And Richard Dixon, president and CEO of Mattel, is taking over as Gap's next chief executive. The Wall Street Journal reports that Mattel told staff about Dixon's departure early today. Now, shares of Gap right now, they're up about 7%. Those are the stories that we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And from Bloomberg World Headquarters in New York, I'm Denise Pellegrini. We check the markets all day long for you here at Bloomberg. Stocks are higher right now. We had been mixed, but we are higher. And this is all ahead of the Fed's expected announcement on interest rate hikes coming in just a couple hours. We're tracking it all for you here on Bloomberg Radio with live special coverage looking at what the Fed does and says and, of course, what it all means. And the Dow right now, it is higher, up just about 53 points. Call it 0.1%. The S&P 500, though, it is lower now, down 0.1%, about 5 points. And the NASDAQ is lower, down about 0.3% or 48 points. The yield on the 10-year right now, 3.88%, we'll call it. A little bit coming off yesterday's levels, but still it's been inching its way higher. Spot gold right now, it's up about 0.4%. That's about 7 points higher, $19.72 an ounce. And crude oil coming off the highs that we saw yesterday and the day before. Today it's down about 0.8%, down about to $78.94 a barrel. And shares of Meta, they're in the spotlight today. They're up about 0.5% right now. Big focus on whether the expected recovery in digital ad business, which is its main source of income, actually took place. We'll be watching for their quarterly results after the bell. Also for any word on its AI initiatives and what traction it's seeing there, and also what's happening on Threads. And Boeing shares surging about 7%. The plane maker generating way more free cash flow. Also beat on revenue and earnings, though I should mention the earnings beat was smaller than expected. And that is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate it. It is Fed Day, just under 2 hours. We'll hear from the Fed at 2 o'clock. Let's get a sense of kind of where we might go here, what we might hear from Fed Chairman Jay Powell. We do that with Jeffrey Cleveland. He's a director and chief economist at the firm is Payden and Regal. Jeffrey joins us via Zoom. So, Jeff, is the Fed done, or do they feel like they have more work to do?
I think they feel like they have more work to do. I think they have more work to do. Labor market is still hot. The economy is rocking. We grew 2% at an average rate, I think, in the first half of the year. Unemployment still near a cycle low. So I think they're on an every other meeting hiking path. So they hike here today. Maybe they skip in September, but then they hike again in the fall. So I don't think they're done. So that's my take at this moment.
Okay, well, just to give the contrarian take, the Fed's favorite data point, Supercore, has been cooling a little bit. Do you think that if that continues, that would change your calculation?
I acknowledge we've seen one good CPI report, that soft reading. So I have to admit that. I think if you're a policymaker, though, you don't want to see one, you want to see a string, 3 or 4 soft readings. And we did a chart of the week before last, looked at median CPI month-to-month change. That still came in for June, 0.4. So it wasn't nearly as soft as the regular core CPI. So I think it's far too soon to declare victory over inflation. I don't think the Fed will want to do that either.
Well, how about the risk of recession here? This Fed potentially could push this country into a recession. What's the risk there, do you think?
Go back to the start of the year, and people were talking a lot about that. But, it's remarkable. Its core CPI, let's say last summer, was 6.6% year on year. As of June, it's 4.8. So it has come down, as I said. And over that time period, the unemployment rate is basically flat. It hasn't gone up. That's a remarkable outcome. I think most forecasters thought in order to get that cooling in inflation, you would have had to see a recession, a rise in the unemployment rate, and we haven't seen that. The Payton and Regal forecast right now is that we won't see a recession in 23. We think we're seeing pretty decent growth, like I said, 2%. Payroll growth is strong, so we'll get through this year without a recession. And the bigger problem still remains inflation. And if I may, just to be a contrarian to my own view, there is a chance the Fed is even more hawkish than we all think. There were 2 policymakers right before we went into the quiet period for this meeting who put out speeches. So that we had Lori Logan at the Dallas Fed, and we had Christopher Waller at the Fed board. And he said, hey, maybe the policy lags are shorter, and we should have already seen economic impacts, slower growth, and softer inflation. We haven't really seen it yet.
Yeah.
And if that's the case, then we need to do more, and we need to do it sooner. So that there is a chance we get a little more hawkish tilt today. I want to put that out there.
Yeah, well, and the Fed has data that we don't have. We were talking about earlier, they have access to the Senior Loan Officer Survey, which could color their view. Having said that, I'm curious about consumer spending and how that plays into your view. We keep talking about how the consumer is so strong, but I'm seeing a lot of instances of increased credit when it comes to how the consumer is continuing to spend. Is that impacting your calculation on that resilience?
We tend to look at the labor market every month, and we look at, how many people are employed, how much they're being paid, and, how many hours they're worked, just the aggregate consumer income, if you will. We like to call it consumer power. And that's still growing at a 6 to 7% clip, which is kind of where nominal GDP is. So that's still pretty well. I mean, if that income metric is holding up, then I think the consumer has some spending wherewithal. I should also point out that yesterday's consumer confidence figures were really excellent. Consumer confidence rebounding pretty nicely, and at least in the near term, that could point towards a little bit of a pickup in consumer spending in the near term, the next 1 to 3 months. So the job market looks good. That bolsters consumer spending, and consumer confidence has picked up a bit, and that should also help the consumers. I think the consumer is fine for now.
Doesn't anybody point out to the Fed that the inflation trends are trending down? Can't they just?
Oh yeah, they must, right?
Can't they just cool their heels a little bit?
Yeah, all the bond traders point that out to me. They say it's clear, inflation is done. It's in the rear view mirror. It's already gone. And I think the problem is if you're a policymaker and you go back 15 to 18 months, the story from policymakers was that the inflation we were seeing was transitory, if I can use that word, right?
Yeah.
And it turned out not to be. And then they had to quickly catch up and admit that mistake. So I don't think they want to make that mistake again by saying, hey, the models look good, the forecast for inflation have it coming down, it's moving in the right direction, so we can rest on our laurels. I don't think they want to make a mistake. You could call it once bitten, twice shy, but if I'm a central banker, I want to see inflation way closer to 2% before I change my tone.
I guess I wonder, what is the harm in waiting? And also, how sticky is that 2% goal going to be? Is the Fed going to start to declare victory around 3% and say, yeah, we're losing credibility, but it's worth it to just stop the trauma of this constant rate hiking cycle?
I don't think they're going to shift the 2% target. If they did, that would be, they have these framework reviews. These things play out over years. We had one, a few years ago. I think it took 18 to 24 months. So maybe if we have this discussion in 2027, we'll have a 3% inflation target. I think there's a lot of bond investors who put that to me. They say the Fed should go to 3% target. I think this is a very bad story for the bond market. Why? Look at inflation expectations. Bring up on the Bloomberg terminal your break even, your 1 year break even, 2 year break even, 5 or even 10. Bond investors, based on that implied inflation expectation, think that inflation is going to be 2%. The central bank suddenly says, hey, we're cool with 3 to 4%. Inflation expectations are going to have to be a lot higher, and so are interest rates. So I think bond investors are very short-sighted by pushing that higher inflation target story. So I don't think that's the route that they're going to go down.
Well, if nothing else, this Federal Reserve, Jeff, has been really clear on their messaging, I think. We could argue that they were late to the party and maybe they're going to be late to leave the party, but they've been saying we're fighting inflation and we're going to continue to be vigilant on that. Does the market really believe them, do you think? Because you look at some of the WERP function, and they've had the Fed cutting rates in the not too distant future.
Yeah, we've seen this 4 or 5 times in the last 12, 15 months where the bond market thinks they're done and then they're going to shift to cutting. It's been wrong every time. Is this time different? I hesitate to say that based on my earlier views about the strength in the labor market and the inflation trends. I think the market is just premature saying that this is the last hike, and definitely premature in starting to put cuts in the early part of next year. But for that, now that you got me going, far too many cuts priced into next year as well. But the market gets things wrong from time to time. It's not infallible. So this could be another instance of that.
Well, and as you told us to look it up on the terminal, so I pulled it up, and it looks like anticipation of CPI for 2024 is at 2.5 and 2025 is at 2.3. So we are seeing that optimism of us moving toward the Fed's goal. In our final minute with you, I want to go global for a second because we do have a central bank triple header this week. Are you anticipating us learning anything more from the ECB that we might be learning from the Fed about kind of the global fight against inflation?
I think the ECB is in the same spot as the Fed in the sense of, you go back a year or so ago, everyone said, oh, yeah, we have inflation here in Europe. A lot of colleagues said this, but it's all food and energy driven. As soon as energy prices come down, everything will be fine. Flash forward to present, that's been wrong. Services inflation, last week, again, our chart of the week last week, services inflation hit an all-time high for the Euro area. So you do have broader inflation, and the ECB still has more work to do. So they've probably got at least 2 more rate hikes, maybe more, from the ECB. The thing that I think is interesting is the divergence in the macro data between Europe and the U.S. So as I said, before, the U.S. is holding up pretty well. Growth looks good. It's not so positive in the euro area. We have weaker growth readings across a range of different data. Economic indicators have surprised pretty substantially to the downside versus forecast for the first part of the year. So you got the same kind of inflation problem, which keeps the central bank going. But Europe is, I think, less able to handle it relative to the U.S. is my view.
All right, Jeff. Always great to catch up with you. Jeffrey Cleveland, Director and Chief Economist at Payden & Regal. Right now, let's head down to Washington, D.C., World and National News with Nathan Hager.
Well, Paul, we did get a headline a few minutes ago on the Bloomberg terminal that President Biden's son, Hunter, has pleaded guilty to tax crimes in a deal with the Justice Department. This comes after the plea agreement appeared close to falling apart in federal court in Wilmington, Delaware. There was a provision that would have allowed the government, or would have had the government, agree not to prosecute Hunter Biden further. He was expecting to plead guilty to 2 misdemeanor tax crimes and avoid jail time on a gun possession charge. The judge called a recess to have both sides discuss their differences. After those discussions, they agreed that the non-prosecution agreement on the gun charge is separate from the deal on the tax charges. The judge had questioned whether those agreements were linked. Actor Kevin Spacey has been acquitted of sexual assault charges in London. The 63-year-old had been on trial for 4 weeks over claims from 4 men who said they had unwanted encounters with the Oscar winner in claims dating back 20 years. Prosecutors had called Spacey a sexual bully. Spacey's lawyer says 3 of the men were liars. Spacey said he was humbled following the jury's verdict. Rudy Giuliani is admitting to making false statements about 2 women who counted the ballots in Georgia back in 2020. That concession came in a filing last night in the federal defamation lawsuit against him from Ruby Freeman and Shay Moss. The 2 women accused Giuliani and others of promoting a video that claimed to show the 2 women manipulating ballots in the Georgia 2020 election count. Florida Governor Ron DeSantis plans to give a major economic speech next week as he continues his 2024 campaign reset. Sources tell Bloomberg News the governor and his team have spent the last few days drawing up remarks that touch on inflation, China, domestic manufacturing, and energy policy. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 12:20 on Wall Street, 12:40. We check the markets now all day long for you here at Bloomberg. Stocks are mixed, and that's ahead of the Fed's expected announcement on interest rate hikes coming in just a little over an hour now. We're tracking it all for you here on Bloomberg Radio, and we will, of course, have live special coverage throughout the afternoon, so stay with us. Not only on what the Fed says, but what it all means, because sometimes, that Fed speak, a lot of people have a lot of different interpretations, so we'll be covering that. And one of the things that we're looking at is what the Fed says and does, not only about now, but about the future. Ethan Harris, head of global economics at B of A Securities, says the Fed has learned a lesson, and it's not going to ignore inflation again going forward.
They started too late, and then they did an incredibly aggressive catching up. And that was a signal to me that they understood that they'd made a mistake. Because you don't want to be going 75 basis points a meeting. It's very dangerous normally. But if you're way behind the curve, you catch up. So I don't agree with people who say they're going to compromise on their inflation target. At his press conference, he repeats over and over and over again. Every chance he gets, he says, we're serious about hitting our 2% inflation target. He's putting his credibility on the line. He does not want to be Arthur Burns. He wants to be Paul Volcker.
Yeah, wants to be Paul Volcker. That's one of the fears. Harris there on the Bloomberg Surveillance podcast. Stocks are mixed. Maybe investors are hedging. The Dow up 38 points, about 0.1%. The S&P 500 down 0.2%, 9 points. The NASDAQ down about 0.4%, 61 points. The yield on the 10-year right now, it is 3.88%. Spot gold higher by about 0.3%, 1971 an ounce. And crude oil right now, it is down about 0.8% at 78.95 a barrel. We're also tracking shares of Meta closely. They're up about 0.9% right now. We'll be getting Meta earnings after the bell. Big focus, of course, on what they say about AI, what kind of traction they're seeing on Threads, the Twitter answer there, and also to a lesser extent what they say about their video posting service, Reels. And of course, there is that contempt citation against CEO Mark Zuckerberg brewing from congressional Republicans. We're watching that as well. See if they say anything about that. And that is a Bloomberg Business Flash. Back over to you guys.
All right, Denise Pellegrini, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so check that out. And you just have to search Bloomberg Global News, and you'll find it there. Bank news continues to hit the tape. We had some earnings out. We had some buyback information out. Let's bring in Allison Williams. She's a senior analyst for Bloomberg Intelligence, covering all the global banks. And Allison, let's start with Deutsche Bank. They had some earnings today. What's the takeaway for the German lender?
I think the takeaway was that core trends are pretty good, similar to what we saw at the U.S. banks, that net interest income is holding up better than expected. So obviously we're different rate regimes, but that is the key positive, and especially true for Deutsche Bank. Trading, which is the biggest part of their business, fell 10%, so that doesn't sound heroic, but it's better than the 15 to 20% view that they've had in June, and they have an outlook that should be improving in the second half. But their corporate bank and private bank, which are their more stable recurring revenue businesses, also doing better, increasing their share of the overall top line, so investors like that. Core cost cutting coming in line. They're delivering on their efficiencies. Investors like that. What investors don't like, I would presume, was a negative for me at least, is the fact that their non-recurring costs coming in higher, so restructuring, legal costs that we've heard a lot about, and severance. So this is something that we've seen at most of the U.S. banks. Citi and Morgan Stanley had relatively bigger charges, but we know that there's job cuts. The severance costs come today, but should help the second half profit. And then finally, buybacks, which they had actually announced last night. So it's a $450 million buyback. It's about 2% of their market cap. That's no way in comparison to, you look at Wells Fargo, who also had an announcement last night, $30 billion program 18% of the market cap, although that will be over some period of time.
I want to transition stateside and talk about PacWest, which was up by 30% earlier today, now up by 27% on that news that it'll be sold off to Bank of California. Talk us through that deal and why the market is responding so positively to both of those names.
I mean, I think, to some extent, just getting some resolution to some of the issues that we saw in March, and PacWest was, certainly one of the banks that investors have been watching. And I would say that, the fact that that deal will get done and the fact that across the industry broadly, we're seeing deposits stabilize, the cost of deposit pricing going up in the quarter, but generally the outlook more favorable is giving a lift to all the banks.
Allison, you talked to us. You mentioned the Wells Fargo buyback, $30 billion, 18% of the outstanding. That is size, of course. What does that say about the regulators' view of the big U.S. banks? Now that they're allowing them to return some capital to shareholders.
So I think Wells Fargo is a little bit of an exception. Certainly the regulators are allowing them, today, but tomorrow we do get these Basel III endgame rules, and so that's going to be sort of another kink in terms of raising capital requirements for these banks. For Wells Fargo in particular, because they do have such sizable excess. And again, it's a $30 billion, but it's not necessarily today, so it's over a specific time frame. But the Basel III endgame rooms are thought to be a little bit more punitive on the trading side of things. That's a smaller business for Wells Fargo.
And moving back to the regionals, again, are you anticipating that the regional bank rally that we're seeing today because of the PacWest move, is that something that's going to be a little bit short-lived, or are we seeing more success to come for some of those regional names?
Well, I think, going back to my comments on, the deposit stabilization and just sort of moving past this issue in March, right? So that was really where the dramatic underperformance came from these banks. First was the fear, and then was just the recognition that, beyond the fear of deposit flight at a few specific banks, there was this broad fear about the cost of deposits rising, those deposit outflows. That migration is expected to continue, but certainly not at the fearful pace that we saw in March. We saw that things were much more stable in the second quarter. And then, the outlook from the banks is that will continue to look better. Of course, part of that is predicated on rate cuts from the Fed that are built into the curve in the coming quarters. So monetary policy will continue to play a role.
Allison, talk to us about this Basel III rules that you referenced. Pretend like we know nothing about what they are. So tell us what they are and why they're important for the big banks.
So first is just the name Endgame. I mean, can we finally just get the final set of rules that we'll be dealing with? The Basel III implementation has been, the guidelines and the rules, this has been going on since the financial crisis. So well over a decade in terms of regulators aim to make the banks safer. And so this last set of rules, which is really the U.S. Regulators' view on implementation, it'll be good to get the final set of rules. I would say that our regulatory and policy experts in BI, we are expecting, that there will be increased requirements across the biggest banks. Regulators have sort of broadcast that could add like a 2 percentage point increase to their capital ratios. This will be the proposal that we get tomorrow. It might not become finalized until perhaps a year from now, and then there'll be a couple of years phase-in period. So the banks certainly have enough, money that they're generating in terms of internal capital to meet these guidelines over any such time period. But obviously it's a negative because it'll lower returns. That's how investors look at the profitability of these banks. But the other side of that is that they are safer and more sound, and so perhaps that could help the multiples.
All right, Allison, thanks as always for joining us and giving us your analysis and expertise on the global banking space. Allison Williams, Senior Global Banks Analyst for Bloomberg Intelligence, joining us on the phone there. Again, Wells Fargo, big stock buyback, $30 billion. That's good news for Wells Fargo shareholders. Deutsche Bank putting up some numbers, as Allison said, were generally pretty solid in a tough environment for a bank that's had its challenges over the years, but still more banking news. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. The president of Stellantis is putting its vast network of suppliers on notice that the company is looking for better deals on components in an effort to protect its margins. Carlos Tavares spoke with Bloomberg TV.
It is also true that when we have to absorb 40% of additional costs coming from electrification, their contribution needs to be a reality as much as we are contributing ourselves from our own plants. So yes, at the end of the day, it has to be a partnership working both ways.
Tavares said he has no plans to lower the prices of his vehicles. He's already squeezing production costs and said more job cuts in the U.S. are possible. Shares of the maker of Jeep SUVs, well, they're up right now about 3%. And it looks like more people are changing up their Visa cards. Bloomberg's Kimberly Adams reports.
The company is reporting card spending growth that was more robust than Wall Street expected as consumer demand for travel and dining out remained strong last quarter. Payments volume climbed 9% to $3.17 trillion in the fiscal third quarter ending June 30th. Visa and rival MasterCard have gotten a boost from cardholders' continued willingness to spend on travel and entertainment. Lisa?
And shares of Visa right now checking in, they are down about 1.5%. And it looks like consumers are willing to pay higher prices to quench their thirst for Coca-Cola. The company raised its full-year guidance after second quarter results showed demand is still strong for its sodas, fruit juices, and sports drinks. Second quarter organic revenue up 11% in the quarter. Shares of Coca-Cola right now, well, they're up about 1%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker studio here. S&P 500 off 0.3%. The Dow unchanged. NASDAQ off about 0.5%. In the yield market, 10-year Treasury, 3.89%. So pretty steady there on the yields as we get ready for Fed Day. 2 p.m. Wall Street time is when we get that statement. WTI crude oil pulling off just a little bit off about 0.6%, $79.13 a barrel for WTI crude oil. Right now, let's head down to Nancy Lyons in Washington, D.C. for World and National News.
Thanks, Paul. A more limited plea deal has apparently been agreed to by Hunter Biden. That's after the judge today questioned the previous agreement, under which the president's son would admit guilt to tax violations and undergo a diversion program to avoid a felony gun charge. The judge questioned the scope of the non-prosecution aspects of the deal and asked the two sides to talk over their differences. After that discussion, Hunter Biden agreed to plead guilty only to tax crimes, drug offenses, and a firearm violation between 2014 and 2019. But he could see additional charges outside the scope of this deal. Secretary of Homeland Security Alejandro Mayorkas has been coming under fire during testimony today before the House committee. And as Bloomberg's Irv Chapman reports, some Republican members are even calling for his impeachment.
All right, a little hiccup there down the technical
yeah,
side.
sorry. I apologize.
That's okay, Nancy. Thank you so much for getting us that.
Yeah, we got that. We'll get back to that later. We have some more stuff going on. You know what? I'm looking at this news story on Bloomberg on the terminal. Swingers, Crazy Golf gets $52 million investment for expansion. So it says, get ready to tee off Swingers, the miniature golf, drinks, and street food experience that began as a pop-up in East London has raised $52 million to fund a global expansion with locations opening soon in Las Vegas and Dubai. The investment is funded in part by Kane International Advisor. So the 40,000-foot flagship location is set to open in 2024 at the Mandalay Bay Resort.
And Paul, I picked this story for you because I know you're a golfer, correct? And according to the National Golf Federation, guess how many rounds of golf are up?
Oh, they've been up.
As of June.
Yeah, they've been up.
Percentage basis, we're at 5.5% year over year increase. So people are playing golf. They're very into it.
We know what happened during the pandemic. Think about it. March of 2020. Yeah. The only thing that, or one of the few things that people could do together was golf, as long as they stayed a certain distance apart and all that silliness in hindsight. And our golf course, which is right across the street from my house, was just jam-packed.
I'm sure.
From sun up to sundown because people were getting out.
Yeah.
And so that kind of continued a little bit.
That's really interesting. That's a really good point in terms of why there's so much demand. But it's interesting to compare that to what we're seeing with Topgolf, which is the closest competitor. We have a public comparison of their earnings forecast downgraded in the last earnings cycle due to waning demand, cutting their profit forecast for the year. But that's definitely not stopping the investment in Swingers, which is the name of this adults-only location for Crazy Golf. And, you know, I think the alcohol license is probably a big part of their success.
That'll be fun. Swingers has been expanding rapidly over the past few years. In 2022, it opened its first New York location in Nomad. That's north of Madison Avenue, I think is what the kids call it. Under the Virgin Hotel, and now has a second location in Washington, D.C. The New York Swingers has welcomed as many as 8,000 people per week.
Yeah, it's huge. I've gotten a lot of offers to attend, and I have luckily been able to decline all of them. This is not my personal vibe, but I'm happy for others.
I mean, you got miniature golf, cocktail, you know, and some tunes being pumped in. That sounds like a good time.
I don't participate in things that make me look embarrassed, and this is one of them.
This would be one of them?
That would be humiliating for me.
All right, we'll see how, but it seems like it'll be perfect for Vegas, and Mandalay Bay is great hotel, great property out there, so that'll be fun for them. So good news, they're raising capital, $52 million. That's a nice round of capital. All right, Sound On with Joe Matthew. It's in D.C. They talk politics.
Yeah.
I think they've got a lot.
I think they got a lot to talk about. Yeah,
with Hunter Biden and all that news. So Sound On with Joe Matthew in Washington, D.C. starts right now.
down a little more than 0.2%. The NASDAQ 100, with after a 41% surge this year, down almost 0.8%. Even with those rises in big name tech stocks like Alphabet, the 2-year yield up just a little bit, about 3 basis points to 4.89 on the day, and the 10-year yield standing about steady at 3.89. And now for the Fed. The U.S. Central Bank is poised to raise interest rates to the highest levels in 22 years. Bloomberg's Michael McKee is at the Federal Reserve with more. Mike?
Well, Sonali, it was 2001 when the Fed funds rate was as high as it's likely to be at the end of today's meeting, 5.5%. The Fed is 97% sure to do that, at least according to the OIS markets. But what's interesting is you look at the future Fed meetings this year, and you see that the markets are generally pricing in a skip in September and a slight chance of an increase in November. They aren't sure, and they start to price in a cut in December. So what you're likely to see today is the Fed basically raising rates, dropping one sentence about holding to assess economic conditions from the statement, and then it'll be up to Jay Powell pushing back on the idea that the CPI was any kind of trend. One data point doesn't make a trend. And then he'll say, no, we are not going to cut rates this year. We're going to hold rates where they are until we're certain that the CPI is on its way down. Because there are headwinds and risks ahead. And he said, he will say, as he has said many times, another hike will depend on the incoming data.
One data point doesn't make a trend, and one voting member doesn't make a full committee. How divided do you see the FOMC being when it comes to more rate hikes versus having a level of comfort with inflation that's riding above 2% for a longer period of time?
Well, there is definitely a division on the Fed over those who think they need to go further and those who think that they should hold. But the ones who think they need to go further don't necessarily think they need to go a whole lot further now that Jim Bullard has dropped out. He was 6.25%. But the question is, do they have any kind of dissent at a meeting where they raise rates? And if the committee is led by Jay Powell, who says we should raise rates this time, then those who are more dovish will probably go along and we won't see any dissents. But you'll hear about it in their speeches after this meeting.
Bloomberg's Michael McKee, thank you so much. We're looking forward to your coverage moving forward. Now we're going to bring in Simon Freakley, the CEO of Alex Partners. You know, Alex Partners has advised many a CEO, hundreds around the world, as well as very high-profile restructuring. So when we're talking about inflation and interest rates, you're a very good person to talk to. The reason for these rates are due to higher inflation, potentially sticky inflation.
Right.
When you speak to CEOs, how much is still inflation pinching margins here?
Inflation is probably top of everybody's agenda, honestly. Every executive committee is focused on how to thrive in an inflationary environment. It's very tough.
Well, how much of it is coming from the wage picture in itself? How sticky are the wages? And do you expect there to be more upward pressure there?
Well, there's a combination. It's like a layer cake. You know, every single layer is a problem in itself, but together they're quite a challenge. So wage inflation is certainly an issue. Materials inflation is certainly an issue. But going back to labor, the talent market is still very tight. The skills market is even tighter. To get the critical skills to pivot business models, particularly in a digital era, is becoming a real challenge.
It's interesting because this FOMC meeting comes before another jobs report very soon after. And when you talk to CEOs across the globe, really, especially in the United States, do you expect that there would be more pressure on the job market in terms of layoffs and firings? We've seen a fair bit already.
And of course, we've seen it particularly in the tech sector, maybe some overhiring during the pandemic, which is now redressing itself. And in New York, of course, we're seeing it in office occupancy. But the labor market is still very tight. And so it's this combination of forces, these multiple disruptions, if you like, that are making it so challenging for business leaders, not just domestically in America, but around the world.
Well, do you think also that the Fed will achieve the ability to make it into a soft landing? Or are the executives that you speak to more often preparing for a harder time still?
Well, the real question, I think, is not is it going to be a recession with a small r or a big R, but what are the things that business leaders can do now to pivot their businesses to do the best they can in these circumstances? So the best business leaders around the world are leaning into the things that they can do now, not being a hostage of any strategy that's gone before, making sure that costs are as variable as possible, making sure they're focusing on their core activities, making sure they're liberating liquidity from non-core activities, because out of cash is out of options. The best business leaders are staying agile.
You know, it's interesting because inflation is one part of the story in terms of what businesses are struggling with, but this rise in interest rates has certainly had a large impact already, the highest level of bankruptcies since the global financial crisis. Alex Partners is one of the largest restructuring experts in the world. Do you see this expanding quite meaningfully here as we watch a delayed effect of these interest rate hikes?
Yes, and so you're right. In 2023 so far, there's been an uptick in Chapter 11 filings, but truthfully, Shanali, that's just the tip of the iceberg, because all the businesses that aren't likely to file are still suffering the distress of higher interest costs. But this is the thing that people aren't focusing on. The bigger problem than the cost of debt is the availability of debt. These maturities are coming due in 24 and 25. Even if people can afford to pay the interest rates, will anybody lend them the money? And this is the real issue to watch.
So it's not even just the idea of higher interest rates. Once the Fed tightens further, how much might liquidity be drained from the system that perhaps the market is not accounting for?
That's right. Can they lend is one question. Will they lend is another. The availability of debt is going to be a key constituent of people's 2024 strategy, and that's why you'll see defaults go up.
Do you think that the market is discounting how much defaults might actually tick higher, given that you're seeing potential liquidity constraints, as well as to the point you're making, those maturities don't even come due until next year, the year after?
Yes, I think there's some discounting going on, but I don't think it's fully reflected yet. And even if the maturity doesn't come due until 2025, you'd better know in 2024 what your available strategies are. So I think this is going to become very real.
So do you think that some of these effects that we're seeing in the economy, this idea that everything is okay, that margins are under pressure, but not all that much, do you think that given the distress that you might be expecting into the next 2 years, the calm today doesn't really give a full picture of the issues we might see tomorrow?
I'm more optimistic than that. I think there'll be winners and losers. I think the best run businesses, the best capitalized businesses will still thrive. So I don't think it's a generalized view. I think those businesses that maybe are struggling to meet their interest payments today are going to find that they can't make their interest payments tomorrow. Those management teams that haven't taken cost out of their business to keep flexibility, haven't made sure they have liquidity to pivot on the back of the opportunities they have for growth, are going to find they're going to be failing enterprises. So there will be winners and losers, but I'm still optimistic.
You know, when you think about the overlay of the new hot topic in town, artificial intelligence, generative AI, do you think that this is going to have a significant impact on the economy, on jobs moving forward in a way that investors might not be accounting for in the next year or two?
I think generative AI is going to disrupt every job in every industry, in every geography. So I think it's going to touch us all. Will that displace labor? It may redistribute labor to different jobs, but I'm optimistic about the impact. I think there's more opportunity in generative AI than there is challenge, and every major technological disruption in history shows it doesn't decimate the job market, it just redistributes the jobs to be done.
Between tech spending and higher labor costs in terms of rising wages, when you speak to executives, what is the single biggest inflationary pressure that they are facing?
Well, it's certainly wage cost, it's certainly materials cost, but those challenges are compounded by still some supply chain disruptions. And what they're doing is making sure that they're looking for the opportunities, the tactical opportunities to drive growth and margin. Netflix, for instance, by stopping their subscription sharing, very smart, because their net additional subscriptions are outweighing the retractions. And so people are looking for the eddies in the stream to try and drive the performance of their businesses.
Single biggest thing that's misunderstood as you're speaking to executives about the state of the economy as it stands today, before another set of rate hikes and potentially even another on top of that.
Yeah. The single biggest mistake people typically make is thinking that the past is a predictor of the future. People shouldn't look back to see what they should plan going forward. They need multiple strategies, they need multiple options, and they need to move quickly, because doing it nearly right, but doing it now is at a premium.
Simon, thank you so much for your time. That is Simon Freakley. He is the CEO of Alex Partners, one of the largest restructuring firms in the world, I should say. Coming up, the new U.S. home sales fall for the first time since February. We're going to discuss this with Kevin Thorpe of Cushman & Wakefield up next. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Markets, and I'm Shonali Basak. The U.S. new home sales declined in June for the first time in 4 months, suggesting that interest rates and high property prices are starting to strain the market. But home prices in the U.S. have climbed for a fourth month, both due to demand and tight inventory. Remember, the Fed is watching housing prices closely, with Dallas Fed President Lori Logan warning in July that a rebound in housing prices would pose an upside risk to inflation down the road. Here to discuss just that is Kevin Thorpe, Chief Economist at Cushman & Wakefield. Kevin, thank you for joining us. If you take a look at the risks to inflation and the path the Fed is on, do you think that they'll need a hike that is above and beyond what we might see today?
I don't think so. I think this is pretty baked in. The FOMC will follow through as expected. We'll find out here soon. They'll raise, our base case is a 25 basis point hike. And I think that might be the last hike. The Fed is now kind of more than sort of double the Fed funds rate, more than double the long run equilibrium rate. So I think sufficient enough to slow the economy, bring inflation in. We're seeing good progress in inflation, which your program's covered. CPI has gone from 9% to 3%, stickier components, core CPI, super core trending in the right direction. I do want to point out, keep your eye on the employment cost index. That's coming out on Friday. I think that's going to be really interesting on wage growth. But on commercial real estate specifically, the property sector, we're looking for these signals because I just for your viewers, I think it's worth noting that historically, kind of as you near the point where the Fed is going to make this first move down, which we think is going to be early next year, that's kind of the best time to buy property. If you kind of go back even prior to COVID, the last time the Fed was cutting rates was September of 2007, if you can remember that. And if you went out and bought a building, literally that day, your property appreciated by 200% sort of cumulative returns over the next 10 years, right? So I just think this is a critical point in the cycle. I think we're nearing the end of the tightening cycle, I think. And bigger bets are going to be made here. And if history is any guide, those bets I do think are going to garner very, very large returns.
News you can use, Kevin. Very much appreciated. But what about this idea of any future price shock risks? This idea that housing prices or wages could move inflation higher and really start to impact this idea of a cut next year?
Yeah, I do think that there's softening happening in the housing market, right? And that actually that should help. Home sales have come down, which isn't that surprising, right? We had this major run up in home values going up into this year. We've seen mortgage costs, right? The mortgage rates go from 3 to 4% to 7%. There's this lock-in effect, right? Where if you bought over the last couple of years, you're kind of locked into that mortgage rate. and you're really not in a rush to sort of sell your property and go take on a mortgage rate of 7 or 8%. So I don't find this that surprising. And I think what we're going to actually see with inflation is there's this feed-through impact, right? We all know that housing kind of lags in the way, the CPI is calculated, and that's going to start to filter through in the second half. And I'm not so sure that we're at this point now where home prices, I know that they've started to drift higher again. I think there's another shoe to drop here in home values. You almost have to come back down. Home values have to come down for affordability reasons. So I do think that maybe the last couple months of home price growth, more of a blip than it is sort of this longer term trend.
Not just the growth, but also the distress. There's a lot of worry here about just how much the commercial real estate industry could start to fall off a cliff, particularly with offices. How much do you expect higher rates to keep on impacting some of the distress you've already started to see? Does it get much worse in here?
Sure. I mean, it's a challenge, right? We went from this 10-year Treasury yield at 1%. It's up to 3.5, drifting towards 4, right? And so that's putting pressure on property. There's no question about it. I would emphasize, though, that sort of the headlines, kind of what you see in sort of distress, that's not really happening across the broader commercial real estate sector. Even if you just sort of look at delinquency rates, in the U.S. So owners that are, 30 days past due on their loan payment, that's actually still pretty low. It's around 3% nationally for all, across all commercial real estate product types. For context, it really reached 10% during the Great Financial Crisis. Hotels were closer to 20%, so we're in the 3% now. And so I'm not seeing evidence of widespread distress, even in office. It's the delinquency rate's around 5% right now, right? So for every 5 buildings you see in the headlines sort of as distressed, there's 95 others that you don't see, right? That cash flow positive, no current issues. But don't disagree with your point that we're going to see more distress. That's like the easiest prediction to make, right? This move up in interest rates is going to create some value destruction. I do believe the bulk of it's going to be concentrated in the office sector, right? We have a wave of loans maturing here over the next couple of years in this, tighter credit markets. It's going to make refinancing very difficult. So that's a problem. We know that there's certain lower quality office product that's kind of being rendered obsolete from remote work. So there's problems here, but commercial real estate's very nuanced, right? There's, it's very, it depends on quality and geography. That's not what you probably want to hear. Your producer's probably in your ear right now saying, get this economist sort of, off the air. Commercial real estate's nuanced, but it is.
No, nothing like that. Now everyone knows exactly, Kevin, when to buy a house next year. That is Cushman & Wakefield Chief Economist Kevin Thorpe. We thank you so much for your time. Now, still ahead, Bloomberg Economics sees a decision today as the peak of the rate hike cycle. We're counting down to the Fed announcement in just over 40 minutes. This is Bloomberg.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Wednesday, the market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come? Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
This is Bloomberg Markets, and I'm Shanali Basak. After considering a range of scenarios, Bloomberg Economics has good reason for betting on an end to the interest rate hiking cycle in July. The most plausible scenarios, rate cuts seem to be offing in the not too far down the line. Bloomberg's Economics chief U.S. economist Anna Wong wrote that report on that forecast and joins me from D.C. Anna, thank you for joining us. When we're thinking about kind of the direction of travel here, how much risk is there baked into the prediction that this might be the end? What would cause that to change in the coming months?
Yeah, I think one of the things we're looking for is to see today at Powell's press conference, how much has he taken into account the softening in labor market? We have seen non-farm payroll data surprised for the first time in over a year to the downside. In the previous month, the Fed staff has a way of parsing the ADP number to extract the real signal underlying the labor market. And, in the minutes, we saw that the Fed officials are considering the possibility that, in fact, the labor market is softer than the non-farm payroll looks. And also, the Fed officials will have the SLU survey in hand as they consider the policy this week. And I also think that may show credit conditions are indeed tightening tightening more as we head into the second half of this year. So both reasons led us to think that by the time September rolls around and the Fed can write down a new SEP projection, that may cause them to indicate that, in fact, today's hike is the last one.
Now, how much concern is there that inflation will be riding above 2% into the 3% range for a longer period of time?
Yeah, I think that's a real possibility, and it depends on a lot of things that you cannot observe yet. For example, it depends on what is the trend productivity growth. So if trend productivity growth indeed is only 1%, it means that nominal wage growth has to slow all the way to 3% before being consistent with 2% target. It's very likely that, trend nominal wage growth is 4%, productivity is 1%. In that case, the trend underlying inflation is actually stuck at 3%. But even in that situation, our note indicated that the Fed will be cutting in the next year and next 2 years because real interest rate will be rising as inflation even falls to 3%. So even with inflation being stuck at 3%, the Fed will be set to cut in the next 2 years.
Now, how would you categorize the dispute inside the Federal Reserve when you think about the hawks versus the doves on the direction forward? Because the reality of the situation, it's going to be into next year that the market is looking into, this idea of how many more hikes and when they can actually cut. Yet inflation is still a big concern to many of the committee members.
Yeah, I think there probably are three camps in there. The one camp represented by Bostic, for example, is that rates are sufficiently restrictive. You don't need to do more. You just need to wait for lags of monetary policy to go through. For example, we're already seeing delinquency rate on consumer loans ticking up. So those people think that we're one and done. On the other hand, there are those who think that there won't be a recession. Things are picking up. Lags are super short. No more monetary restraint going forward. They would be in favor of going back, hiking one more time or even more. And finally, there's a third camp that thinks maybe rates are sufficiently restrictive now, but you don't know what adverse supply shocks await us down the line. For example, commodity prices could continue to rise in the next couple of months. So they would want to hike a little bit more just to buy the Fed some insurance in case that adverse shocks should materialize in the next couple of months.
Anna, thank you so much for your time. That is Bloomberg Economics Chief Economist Anna Wong. Now, coming up next, we have an all-star lineup of experts, including JP Morgan's Bob Michael and Jim Bianco of Bianco Research, joining the surveillance team for the Fed Decides. Half an hour until that decision. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So biometrics.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
It's time to do this again. Live from New York City. Good afternoon, good afternoon.
Afternoon.
Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance. The Fed Decides.
The countdown to that Fed decision begins right now, live on Bloomberg TV and radio for our audience worldwide. The Fed rate decision 28 minutes away. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market negative by 1/3% on the S&P 500. TK, that decision just around the corner.
Decision coming around. I guess there's no fun to it. We know what they're going to do, but I'm going to give you a little hindsight back to June 14th. John, you had a 10-year real yield done just before the meeting, 1.61%. We have stormed to a more accommodative 1.51%. And I note that the Bloomberg Financial Conditions Index is not going the way Jerome Powell would like it to go.
Does he care?
That's a really good question. And stop the show for it. I think we're going to find out in the press conference. Does he care? I like the idea that this is a snooze fest. McKee took a nap. He's ready to go. And the answer is, I think there could be some fireworks in the press conference because nobody knows if he cares. We're going to find out.
That news conference 1 hour away. I've tried to make this really simple. I've asked this question repeatedly over the last couple of weeks. Is it one and done, Lisa, or is there more to come?
That's one of the questions everyone's been parsing through right now. Markets are pricing in less than a 40% chance that there will be another rate hike after this one, maybe September, maybe November. But increasingly, this is considered to be not only the 11th rate hike in this rate hiking cycle, but likely to be the last at a time when financial conditions are essentially easing and people are wondering if housing has bottomed and started to reaccelerate.
And maybe inflation reaccelerates year end. We've heard that from a number of characters over the last couple of days. Max Kettner, HSBC, Francis Donald, Manulife, Andrew Hollenhorst of Citi. Lisa, he's talked about that repeatedly.
And then on the flip side, you have a number of people, including our next guest, who've come out and said, who are we kidding? Inflation is coming down. We are going to go back to where we were before in terms of a slow growth, slow inflation kind of narrative. In that scenario, it's not a head fake. So this is really the key question.
Our next guest itching to get in the conversation. Bob, you've got to wait. Just wait a couple more minutes, Bob.
I knew it.
So excited, I know. Your equity market on the S&P 500 then, a little bit softer on the S&P. We are negative by 1/3% here. Yields aren't doing much at all going into the decision. We look at this on a 10-year right now, 388.66. And in the FX market, 6 days of weakness for the euro. Just a little bit of a strength today, at least. So the euro against the dollar, 110.64.
I went on vacation and pretty much it's back where it was when I left, it feels like. Coming up, we do have JP Morgan's Bob Michael, who is itching to get into the conversation and will shortly. iCapital's Anastasia Amoroso and Deutsche Bank's Matt Lazzetti. They'll be taking us up to that 2 p.m. Fed rate decision. Then immediate reaction from KPMG's Diane Swank, Citi's Andrew Hollenhorst, and Jim Bianco of Bianco Research. And after that news conference, the all-important news conference that really will be where the news is, former New York Fed President Bill Dudley will be joining us, as well as BlackRock's Jeff Rosenberg.
It's great to have Bill Dudley there with a high interest rate call. He's going to really push against the first rate cuts. What I love about this is you want the A-team to show up. And I mean, our next guest can show up. If you're Liverpool and you're playing
I'm sorry,
in Bavaria and Salah plays, that's where the A-team for Liverpool shows up for a preseason friendly kind of thing. That's pretty cool.
Is that game the equivalent of Chairman Powell in 60 minutes?
No, the A-team's going to show up. Seriously, no one's looking for a descent. Is this the day where we see a descent? Interesting.
Let's ask Bob Michael of JP Morgan Asset Management. He joins us right now. Good afternoon, Bob.
Happy to be here.
Good to see you. Do we get descent in 25 minutes?
We should get a little bit of dissent. I think there's going to be a faction on the FOMC that believes that they've done enough that you have to wait for the long and variable lags to hit. Remember, the 475 basis point rate hikes only began last June, so now we're a year ahead of only the second one. There are 2 more in the pipeline, and there are going to be others that point to lagging indicators, such as the current level of inflation and the level of unemployment, as their rationale for wanting to do more.
I got a 30-year mortgage out to 7.28%, bank rate 30, the high 7.38%. Can our housing industry or the securitized housing industry that you look at every day at JP Morgan, can they take another 25 basis points?
It's not the next 25 basis points. I think that's okay. What you're already seeing in the housing market is that existing home sales are plummeting. People aren't taking out mortgages below 3% anymore. They're over 7%. That's dramatically changed what they can finance. And by the way, all other forms of borrowing, whether they have an auto loan or they've put stuff on their credit card, that's gone up as well. So they're stretched and they're starting to feel the pain.
They're starting to feel the pain. They were starting to feel the pain a month ago. Maybe 2 months ago. They were supposed to feel the pain much more than they are. Why is it that it's taking so long? And have you pushed out a recession forecast that you still thought was going to be at the end of this year?
We still think that it's going to be at the end of this year. I'd be delighted to push it out into the first quarter, but it's going to be either side of the first year. Frankly, if I go back to last year, knowing what I know now, I would have thought we would have been in recession now. And that's what we spent a lot of time looking at. And we go back to one thing, because the impact of the higher rates, QT, everything was hitting hard back in March when the regional banking system looked on the verge of collapse. And when we looked at the response by the various agencies, we initially likened it to a Bear Stearns moment. In retrospect, that was wrong. It was more TARP moment, because you backstop not only the regional banks, the entire banking system, anyone with deposits of over $250,000. I think that stabilized that. That's injected liquidity into the system. It hasn't changed the end point, which is recession, but the truth is it has pushed it out a little bit.
It also has raised questions about the stickiness of inflation at a time where growth is going to remain strong. I was referring to you earlier. I suspect you'll push back against this idea that we're going to have sticky inflation and the Fed may have to compromise their 2% target. Why?
I think sticky inflation is a load of rubbish. Let's look at CPI. Year over year, it peaked at 9%. You know where it is now? 3%. Look at personal consumption expenditures. I know everyone wants to look at core. It was 5.4, now it's 4.6. It's kind of stuck there. We actually looked at the Federal Reserve statement on longer-term goals and monetary policy strategy. And you know what they have in there? They're targeting 2% on the price index of personal consumption expenditures, not core, personal consumption expenditures. So that's their metric. And by the way, that was 7% last year. It's 3.9% year over year currently. It's coming down.
Yeah, I just want to tell you, John, that when you say classics at Pennsylvania, which at Penn, which is a really, really prestigious degree in liberal arts America, that's what you take load of rubbish 302, and that really gets you set on a case to fixed income research.
Can you imagine being a Southside economist and trying to get a meeting with Bob, and your argument right now is inflation's sticky and things reaccelerate?
It's a load of rubbish.
Yeah,
you know that meeting we've got slotted at JP Morgan Asset Management tomorrow morning? Maybe not. Bob, your other call as well, and Lisa was right to pick up on the recession call. I believe it was rate cuts in September. It was 3%, twos out to 30s on the curve. Has the trade changed, even if the timeline's been pushed out a little bit?
No, the trade hasn't changed. And I would say the one thing we definitely got right was to buy backups in yields on every opportunity. And the high in the 5 and 10 year was back in October. And I know the 2 years gone back up, but it barely broke through the high it's at a couple months ago. So overall, you're looking at yields that are pretty stable. So the planet of bond investors doesn't believe the Fed. They believe that there's opportunity in the long end of the market. What has changed for us is a rate cut in September looks unlikely. The Fed is telling us it's not going to happen. Frankly, when we look at the history of the Fed, midway between the last rate hike and recession, they start cutting rates. What they're telling us is to look at the 1981 experience. They're not really telling us, we're interpreting it as that. And if you go to 1981, they hiked rates in May, they cut rates in June, and recession hit in July. And I think because they're terrified about inflation not being close enough to 2%, they're going to keep policy restrictive until they see recession.
Do you think they're more scared of recession now or inflation?
That's a wonderful question for Mike McKee to ask.
And Chairman Powell. I think we've all got to understand the answer to that.
I think it's split right now at the Fed. I think it's split.
Interesting. You wonder how that split comes up in about 20 minutes when we get that decision. Bob Michael's going to stick with us. We've talked a little bit about the Treasury market. Need to talk about credit with him as well. Tom, if you're looking for a slowdown, a downturn in this economy sometime soon, what's the trade on credit at the moment?
The ambiguity right here is amazing. If you look at the Bloomberg Corporate Total Return Index, I mean, it is in betweeny and has been in betweeny, which just tells you it's going to cut either way based on a news. So I really didn't participate in that last discussion with Bob.
Were you distracted?
David Hellyer, Giles Turner, Ruth David, Tottenham Hotspur future in disarray.
Yeah.
I'm sorry, I just checked out there. I'm sorry. I'll do better after the press conference.
Your transfer window's got a bit messy given what's happening with ownership.
It's just Harry Kane to Liverpool. It's possible.
Deutsche Bank's Matt Lazzetti is coming up. We won't talk about that with him. iCapital's Anastasia Amoroso alongside him. We'll be talking about the Federal Reserve, that decision, 20 minutes away.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The most likely path is one and done.
One and done.
One and done.
It's one and done.
That's what I would do if I were there.
July 25 basis points hike. That's in the cards.
Baked in the cake, the done deal. We'll have to see what happens from there. Really, the only question is what happens after Wednesday.
What kind of signal do they give us for September?
You could get one more hike after this one.
The timing of the next possible rate hike is October-November meeting.
It's going to depend on inflation as well as the growth trajectory.
Powell's really going to have to do a lot of the heavy lifting.
Probably going to be hawkish.
He cannot go dovish.
He'll keep a rate hike on the table.
Keep the optionality to hike further.
We'll get a lot more data between now and then to try to figure this out.
There is a pretty big consensus out there.
Fantastic.
One and done. And that one for many people comes in 15 minutes' time. We'll see if they're done. You'll get a clue on that in the news conference in about 45 minutes from now with Chairman Powell. Going into all of that, the price action looks a little something like this on the S&P 500. Equity markets pulling back just a touch by 1/3 of 1%. On the Nasdaq, we're down by 3/4 of 1%. The attention will shift away from the Fed later to Meta after the close, so look out for numbers from them. Then on to next week, a week tomorrow, you'll get numbers, Tom, from Apple and from Amazon too.
Yeah, that was great. 2 of our interns put that together like at 2 a.m. yesterday.
I think that was my team for the Open, Tom, about 12 hours ago in the middle of the night.
Yeah, it could be like, 2 a.m., whatever.
And that's the actual story.
John, the actual story here is what's the great missed call back to your year-end report that you did, John? The great call here that we missed was the growth of the American economy. Witness Meta, witness Coca-Cola today with a stunning construction. Nobody looked for a first 6 months out of these companies like we're seeing.
Tech, absolutely ripping.
Jerome Powell didn't look for it.
Just ripping. Lisa, you remember it. I do too. It was sitting cash 5% good times, and then tech kept going up, and it was sitting cash 5% good times, and then tech kept going up, and it just continued.
It was a valuation story, and suddenly with artificial intelligence, it was a sea change story. I think one of the biggest missed calls is the impact of the stimulus money that hasn't worked its way through the system. To me, that isn't that understood, and the lag effects of that very confusing.
Olivia Blanchard codifies that as the Biden stimulus, and he makes clear it's still there. And, I'll let others tell me what the math is, but that's been one of the great missed calls. Just because the time here is we're 15 minutes away from the ballet with Mike McKee and that important statement. What we want to do with the Fed Decides is be eclectic. We do that with Matthew Lazzetti. He is chief U.S. economist at Deutsche Bank. And Mr. Lazzetti was wonderful at saying this recession will take longer to appear, dead on. Anastasia Amoroso joins us, chief investment strategist at iCapital, who linked what the Fed does into a buoyant stock market. And we continue with Bob Michael of J.P. Morgan here, looking at yield and the direct ramifications of what the Fed does. Anastasia, let me start with you as well. Does Jerome Powell care, like Alan Greenspan cared, that it is a bull market?
Well, I think he did at some point, Tom. When you've had the bull market in tech and crypto and all of that was kind of finding its way into the inflation narrative. But that narrative has shifted a lot. We're not in the state of inflation emergency anymore. Inflation is not 9%. As Bob was saying before, it's 3%. So I don't think Fed Chair Powell cares quite as much. I think what he does care about is that the Fed funds rate is now over and above the rate of core PCE inflation and is going to continue to be that way. So my take is, whether you call it one and done, I call it hike and hold. And that's a perfectly acceptable strategy right now, because if they just hold at 5.5%, I'm being presumptive that they hike today, if they just hold at 5.5%, then core PC inflation is on the declining trajectory. So they will continue to increase that delta. They will continue to increase the real rates into positive territory. And at some point, if they just do nothing and inflation comes down, we will actually be at restrictive real rates. So that's what I think Fed Chair Powell is focused on.
Matt, John earlier was asking about what's the biggest threat for the Federal Reserve, the biggest fight. Is it inflation or is it recession? What are you expecting to hear from them today?
Yeah, I think you've heard from officials that it's coming into greater balance, this risk assessment that they have. And certainly as inflation has shown some broadening out of disinflationary pressures, I think that they view that risk has subsided somewhat. But at this point, I don't think that Chair Powell is willing to say that very clearly the risk has shifted to the growth side. The reality is we've had one softer inflation print. It was a good development. We expect to see more. But I think the Fed has seen head fakes over the past year. They're going to want to see that continue over the coming months. And so at this point, I do still think that they view the risk assessment as too much a little bit on the inflation side of things, particularly given the growth in labor market dynamics that we see and the resilience that's there.
Anastasia, you were talking about keeping the Fed funds rate around 5.5% for a prolonged period of time. Our guest sitting on set is slightly shaking his head, Bob Michael. I know he looks for a potential cut by the end of this year in the face of weakness. How much do you push back against that? Do you think that the Fed could hold rates at about 5.5% well into next year?
Well, I think if the economy is still on solid footing and we're not looking at a recession, that's exactly what the Fed wants to do. They just want to stay there for a prolonged period of time to make sure inflation does come down towards, let's say, 2.5%. Look, I don't think we have a perfect crystal ball on when this recession ultimately is going to materialize. But if I just look at the real rates, and if I look at the forecast of real rates, we're likely to get towards 2% real rate, given the forecast that we have today, at some point in 2024. Wow. And if you compare that 2% real rate that's sometime in 2024, you compare that to the neutral rate that the New York Federal Reserve says it's somewhere around 1, it's likely to decline to 0.9 or 0.7%. At some point, Tom, we do get into that restrictive territory, but I think that point is still out in 2024.
John, let me frame this. This is a bold statement by Ms. Amoroso. The idea here of a 2% 10-year real yield before 07, I extrapolated out a moving average 2.05%, and most experts like Bob Michael are saying to me, not this time. Anastasia's maybe an outlier there.
Bob Michael, jump in.
No. I have a tremendous amount of respect for Anastasia. We used to work together. I completely agree with her. We have to listen to what she's saying. She's saying they do one and done, then they're on autopilot, and they let everything else do the work for them. Inflation will be coming down, so the real Fed funds rate will be rising, and they've also got quantitative tightening running in the background. They don't need to do more than today. They actually don't even need to do today. They'll do it.
You're dissenting?
I would be a dissenter if I was on there, but the work is being done for them in the background.
Okay, you're both talking about really important things. So nominal rates stay stable, inflation comes down, so real rates climb. By definition, what does that mean for credit markets, for risk appetite?
It means that the cost of funding is starting to look too high on a real basis relative to their earnings. And some of the fractures we're seeing in the consumer, where deposit balances in the lower quintiles of income are below where they were pre-pandemic, and where credit card borrowing has gone vertical, those things will be very, very painful.
Lucetti screaming at Deutsche Bank wants to cut in here. Matt Lucetti, just let me cut to the chase here within the Lucetti dissent. Are we at a point of instability where you can say we are super restrictive?
No, I don't think that we necessarily are. I think when you look at, most measures of asset-based price financial conditions, things have eased materially recently. And, I think the Fed will have to take account of that. The big question from our perspective, and I think from the market's perspective, is how much of this bank lending conditions tightening is likely to come through the pipeline. Certainly the Fed Senior Loan Officer Survey has shown this big tightening. We should get additional information on that today. But there's reasons to be somewhat skeptical that that is really going to come through, come through and impact the economy. So I'm not sure that it's obvious that at this point, particularly what we're seeing with the labor market and growth dynamics, that we're at a sufficiently restrictive stance.
Where do you think the real yield will go? I mean, we've got this argument with Anastasia about 2% plus real yield. Mr. Michael Steps is, I know it's outside your remit, but do you look for an elevated 10-year real yield, or are we at a comfortable point right now?
Look, I think it all depends on how you measure it. So if we're looking at the actual Fed funds rate minus core PC inflation, no doubt that's going to be rising as inflation moderates over the next year. But the market has that priced to a certain extent. It has this disinflationary impulse already being priced, so has real yields relatively elevated as a result of that. And so I'm somewhat skeptical that policy becomes increasingly restrictive as inflation comes down, because that's exactly what the market already has priced.
Anastasia, just to put a bow on where you and Bob agree and disagree, do you see the entire yield curve at 3%? I mean, are you basically saying that the Fed will cut rates at some point, whether it's the end of this year or whether it's early next year, even as they let things chug along? Or are you saying it's going to stay at 5.5% through the remainder or a significant portion of next year?
My best crystal ball trajectory right now is to say that I think they do stay at 5.5%, 5.25% for the rest of the year, because this economy is likely not yet slipping into recession. But as inflation decisively turns the corner, let's say around the end of the year, and maybe we do get some more economic weakness, because, that's right, some of the, cost of housing and cost of financing credit card transactions, for example, it is going up. So I think once we get more of the consumer consumer weakness and inflation has turned the corner, then that's when I think the Fed may start to talk and actually cut interest rates. So I do think in early 2024, we back off of this 5.25%, level.
Who needs Twitter when you've got a Bloomberg terminal? Some of the feedback I'm getting right now, here's one. Bob Michael should be nominated for the Fed, a market participant, big hole since Kaplan left. Ask Bob if he'd rather have to wear Tom's beige suit or do the press conference for Jay in 35 minutes. That was a good one. This question in here too, Bob. I've let you off on that beige suit all day. In fact, you've worn it a couple of times.
It's 95 degrees out. You know, I'm channeling.
95 degrees. It's not 95 degrees in here.
Well, it's not in here, but it's like 'tis the season.
I've let it go all week. Come on, I've played
King
nice.
Charles wore one the other day.
And then this one came through as well, just on the market, Bob, and I'd like your reaction to it. At what point do we realise this Fed is hand-holding and emboldens risk-taking? High yield spreads are near the tights of the year. The S&P 500 is something like in and around 5% from all-time highs. What would you say back to that?
I think they've realized that, which is why in the last FOMC meeting, when you look at the summary of economic projections, they threw in the expectation of 2 additional rate hikes, even though they didn't hike rates at that actual meeting. I think it's also why they, like Matt, won't acknowledge the improvement in inflation because they don't want the capital markets to run wild with that. They're going to maintain a hawkish bias until they get more comfortable that a full range of inflation metrics are within that 2% sphere.
Matt, as we wait for this to drop in about 4 minutes' time, can we work through the statement together? You've got the first paragraph where they characterize growth and inflation. In the third paragraph, they talk about additional policy firming. I'm going through the statement from the last meeting. Matt, can we just start with that first paragraph? How do you think they'll characterize inflation? They say currently in the last meeting, inflation remains elevated. My first question would be, does that change? My second question would be on teeing up additional policy firming in the third paragraph. Would you expect that to change in any way, shape or form?
Yes, so in the first paragraph, I think there's 2 things. They talk about robust jobs gains. There could be an argument that they change that, but I don't think they do at this point. I also don't think they change the inflation story either, description. I think that comes at the coming meetings if we get additional improvements. So by September, I think they can moderate that language. In terms of the forward-looking guidance language that we get, again, I don't expect that to change. Most officials expected another rate hike. I don't think that they want to send a very dovish message. At some point over the coming meetings, I think they focus on this higher for longer messaging, but I don't think they do that today because I think the market takes that as a signal that they are pausing.
Hey, Matt, this was great. Matt Lazzetti there of Deutsche Bank alongside Anastasia Amoroso. Bob Michael, you're going to stick with us for a little bit. Let's work through that together. You wanted to jump in, I know. Your thoughts?
Yeah, I was interested in, Matt thought they would do anything with the statement on banking remaining stable and resilient. I think that could come out.
Would that mean anything?
It would mean that we don't talk about it because it's not
talking
there.
about it for the last 2 months.
Yeah, but if it's in there, people are going to wonder, why is it still in there?
You don't think they're going to change anything in that first couple of lines on how they characterize inflation, even with the improvement we've seen over the last couple of months? Do you think 2 more prints down the road, on the 10th in August, on the 13th in September, is that enough information then to make a change at the back end of September?
I think by then, the year-over-year will make it evident that they'll have to acknowledge that inflation has improved.
TK, that's the runway into the September meeting.
The runway into September, and I'd go beyond that to November and December as well. We were talking about this months ago. We're trying to get out 2 and 3 meetings on this. Most important thing I heard in this half hour of discussion is Mr. Michael talking about, hey, folks, forget about the parlor game. You know how much I hate it. There's this balance sheet dynamic as well, allowing for further restriction.
The fact of the matter is, Tom, 3 months down the road, and to Bob's point, we're not even talking about the banking issues in the same way anymore, Bramo. And I remember those days we were talking about credit crunch, hard landing. I think the 2-year had dropped to about 350, went back through 5% in the last month or so.
There's a feeling that we really don't know, and that the Fed's a bit gun shy to call one thing or another and to have conviction. For them to come out and say, yes, inflation has eased substantially, means that they could be setting up for another transitory moment at a time where you've gasoline starting to rear back up and you you have housing markets that are continuing to bottom. I mean, this is some of the concerns that people have out there that could really filter into pricing.
I got the CFO of General Motors on the other day. I believe you were in Norway, Lisa. And he's got a $91,000 pickup truck he's trying to sell. I mean, it's the oddest America right now
It's bizarre.
I've ever seen. I got a $91,000 pickup. The first pickup truck Bob Michael had was what? That C10 you had? It would cost $1,800 and you could see through the floor, right?
We are about 10 seconds away from that Federal Reserve decision, with your equity market shaping up as follows going into that. Equities right now just a little bit softer on the S&P 500. On the NASDAQ, we pull back just a touch. With the decision, here's Mike McKee.
They raised rates. That's about it. Federal funds now at a range of 5.25% to 5.5%. That is the highest in 22 years. In their statement, Fed officials dropped the phrase about pausing to assess the state of the economy, replacing it with, the committee will continue to assess additional information and its implications for monetary policy. Future guidance was identical to June, leaving the door open to another rate move in the future. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the statement repeats, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. The economic assessment is little changed. Activity has been expanding at a moderate pace, perhaps a little faster than the modest pace seen in June. Job gains remain robust, unemployment remains low, and inflation remains elevated. Tighter credit conditions are likely to weigh on economic activity, hiring, and inflation, but the extent of these effects remains uncertain, the statement says, and the committee remains highly attentive to inflation risks. No change to QT. The decision was unanimous. Conclusion, see you in September.
Mike McKee. Get on vacation, seems to be the message from Chairman Powell and the team. Chairman Powell's got to speak in about 28 minutes' time, the news conference coming up. That statement, a bit of a snooze. So let's check out the price action off the back of it. It's one. Are they done? That was your rate hike from the Federal Reserve. Your equity market just a little bit softer still, trying to recover. We're down by about 0.2% on the S&P 500. On the NASDAQ, we're negative by 0.4%. The fate of the NASDAQ, of course, through the next week in the hands of earnings from Meta, Apple, Amazon, over the next 7 or 8 days or so. Outside of that, into the bond market, your 2-year yield coming in just a touch, just a little bit, fading after that decision. Now just about unchanged on the day, with the 2-year at 4.88. And if you turn to the FX market off the back of that, with yields just about unchanged, the dollar showing just a touch of weakness against the euro in response to this decision. Euro dollar at about 110.74. TK, a rate hike from the Federal Reserve. It's about the what's next. It always was.
22 years out, you go back, I believe the math is to 2001. Joining us, Diane Swank, Chief Economist, KPMG, Bob Michael continuing with us with JP Morgan. Diane, I'm going to just argue this, and I did this 2 days ago in a YouTube short showing the NASDAQ 100 decline of March of 2001. Things unraveled the last time we were at interest rates of this level. Do we have an analog here to the collapse of the market in March of 2001? Can a Fed policy affect a present stock market collapse?
Well, it certainly can if they go far enough, and so far it's been remarkably resilient. I would argue that we're also seeing this against the backdrop of what looks to be a bubble emerging in Gen AI, which is a little reminiscent of 2001, but not quite there. But I think that's important to remember as well. I think the larger issue for the Fed at this point in time is that financial conditions are fighting them a bit, and even though they've got additional quantitative tightening, they've continued that. That's why they're still going forward. And I would argue one step further in that the good news we've gotten on inflation recently further emboldens the Fed to actually get to that 2% target. There was sort of this sense among people around the Fed and some within the Fed that, you know, they'll get close to 2% and then feel they've kind of done enough because of what they thought would be the pain needed and the trade-off needed to get to 2%. I think they're going to feel a little more emboldened now to actually get there there, which means tighter policy for longer than many expect. And I think that's something that we've sort of not really come to terms with yet, is sort of the unspoken side of what the Fed had been saying, is that people were expecting the Fed to kind of stop short of 2%.
It seems like this is Operation Don't Make Waves. It seems like this was not a Fed looking to jawbone the markets into anything. This was the Fed trying to back into the shrubs and disappear. Diane, would you agree with that characterization? Is that sort of the goal for Fed Chair Jay Powell as he takes the helm of that press conference meeting in about 25 minutes?
Well, certainly they didn't want to change their message. Whether or not that's fading into the background, I mean, given the easing in financial conditions that we've seen, particularly in recent months and in recent weeks, that's something that has to sort of be a bit concerning to the Fed. What they're worried about is not what the inflation data is going to be by September. They're worried about the end of the year seeing a potential acceleration, and that it's a bumpy sort of ride down to 2%, and that we go in fits and starts, and some of those mean an acceleration back up again. And that's what they're worried about. And anything that we see that's too much of an easing in financial markets, that's going to feed into that. Remember, bank credit is only about a third of all credit in the U.S. economy, although there are a lot of spillover effects, even in shadow banking industry for consumers, from the tightening that we're seeing in the banking sector.
If you are just tuning in, welcome to the program. Fantastic lineup going into the news conference with Chairman Powell in about 25 minutes' time. We're talking to Diane Swonk and Bob Michael as well. Bob Michael of JP Morgan Asset Management are with us around the table in a studio. Bob, just initially, your reaction to that decision 5 minutes ago.
I think it was exactly on expectations. They wanted to get the 25 basis points done. They didn't want to convey accidentally anything dovish. They reinforced that additional firming may be necessary, that inflation's elevated. They're trying to do exactly what Diane talked about, not give financial conditions a chance to ease further.
But they are. The Bloomberg Financial Conditions Index, I believe it's 11 ratios. Michael Rosenberg invented it with his team. It still shows an accommodation that screams, I'm thinking of Hollenhorst, it's Citigroup, and others go the other way, including Ellen. The idea, where's the ammo for the next meeting to raise 25 beeps? What's the data that will drive that?
I think they would need to see inflation start to tick up, not stay stable or continue to decline like it's doing. That's the only reason I would think they would hike at the next meeting. I think by the time we get to the September meeting, inflation will have improved to a degree, and I think you'll see more labor market slack that they'll sit there and go, we've done plenty.
Diane, what's your concern for the press conference, given the fact that Jay Powell has a penchant for being a bit more revealing than he'd like, eliciting the reaction that perhaps they were avoiding in the statement?
Well, I do think that they want, I think Jay Powell is going to go into this press conference being a little more defensive in terms of not wanting to ease financial conditions more and not wanting to have a confirmation bias on that. So I think he's going to be much more astute to that in this particular meeting. I do think it's hard for them to raise rates in September. However, we know that in October, the medical component of the CPI at least reverses after 25% decline in insurance from a year ago in the June number on CPI. That reverses both month to month and on a underlying level year over year in October. And once you get to November, you could see a bump up in inflation again that does worry the Fed more, along with some other issues that we've got coming in the pipeline with supply chain disruptions, everything from what's going to happen with grain prices to the fact that energy prices have come back up. All of those things coming back in with persistent demand. Further complicating September are strikes. We've got UAW maybe on strike by September. We have avoided the Teamster strike, but the SAG strike has a lot of spillover effects, which has a potential of giving us a very strange August employment number that could even move to zero or into the red just because of the fallout effects on the industry. And I think those things are going to make it very difficult for the Fed to move in September. But September, they lay out their forecast again. And we'll get the view from there in terms of higher for longer, and do they expect one more hike? I think they're going to want to keep that in their pocket to be able to do it if they need to later in the year.
Bob, Diane just laid out basically sticky inflation or stickier inflation, things that come back, whether it's the labor strikes or whether it's some of these year-over-year comps as supply chain issues rear their heads again, as well as a whole host of other issues, including gasoline. We mentioned that earlier, surging. What's your pushback to that, to all of these base effects that start to lose some of their luster?
That's not what I heard her say. What I heard her say, it's business as usual. Nothing's quite black and white. Everything's mixed. We look at a lot of things in here, and what you're betting on is if wages still remain elevated, that companies will be able to pass along those price increases to consumers. We're seeing that they're not able to do that to the degree they were able to. Consumers are pushing back, they're going down brand. We've also looked at wages quite a bit, and we looked at a lot of them. We looked at unit labor costs, we looked at the employment cost index, we looked at average hourly earnings. We took 6 of them, we weighted them, and we came up with the peak in wage gains was last year. It was just about 6%. Today, it's just under 4%. 3.5% wage gains is what the Fed and Chair Powell have indicated to us is fairly neutral. They're not that far off. It's going in that direction. Prices may go up for certain things, but what we're seeing from the consumer is they'll just cut back spending somewhere else.
Let's talk about this cumulative tightening and pull out a quote from the statement from the Federal Reserve, which on the surface of things sounds pretty boring. It reads like follows. In determining the extent of additional policy firming that may be appropriate to return inflation at 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags, and that's the key word I want to fix in on, the lags with which monetary policy affects economic activity and inflation. Neil Dutter, one of my favorites out there over at RenMax, saying this: the Fed is wedded to the long and variable lags hypothesis. After 18 months, we have seen home prices accelerate, stock prices accelerate, auto sales accelerate, and layoffs sink. Long and variable lags is a concept that might be outliving its usefulness. Diane Swank, I know you've got to run, but I'd love your input on this debate. What are your thoughts on that?
You know, I think actually the lags are much longer than the Fed actually thought. The Fed really had gone into this tightening cycle thinking that there was almost a real-time reaction function, that the lags had shortened, and they were wrong. And in fact, what we saw is this mortgage winter where people won't move out of selling their 3% mortgage home or listing it, or they've already paid off their mortgage and they can't afford to go into a higher rate. The transmission mechanism on monetary policy was blunted. That doesn't mean it doesn't eventually hit, but it has elongated the lags, and I think the Fed is worried about that the lags are still out there, and that's again why you don't move in September, because you could see more headwinds, as we talked about earlier, in terms of credit market tightening, what consumers face, rejection rates on everything from consumer credit cards, mortgage rates, and mortgages and vehicle loans have all soared. Now they've soared over a period since 2013 to